Okay, we are going to work on Comm1140. I'll have my camera out. Sorry, airplay. Oh. Bless you. Oh, I get another free trial from another company. Oh, no Wi-Fi. Should be mirroring now. Very, very nice. Very clean. Happy. Wait, the fuck? Okay. Okay, so what was taught was, do I just go like, just get a notebook that says like, I don't know, revision workshop only. What we initially talked about was ROE, which is ROA times leverage ratio, which is also net profit after taxes over total assets, right? So it's the amount of shit times, well, asset leverage ratio is total assets over shareholder equity. So this is more or less this. Or it's leverage times asset turnover times profit margin. Unfortunately, we were the one that was doing the ratios, so I have the ratios in my head most of the time. Right? There's decrease, increase, you know, different drivers as we go. So I do need him to just show me the, okay. Okay, there you go. So now we have the, sorry, we basically have, okay, anything after short-term borrowings is this. So, I don't know if you guys can see that, but copying this and bringing these short-term borrowings like right here. How do you group these two together? Get my Addy. Okay, so 2022. Sorry, let's do 2023. Leverage ratio was what? Total assets on shareholders. Total assets is where? You see total assets is 5,160 on shareholder equity. Total shareholder equity, which is 3,560. Okay. What they did with this? They start ROE right away and they said, okay, NPAT over shareholder equity right away. So NPAT here is profit after tax is 330. Okay, I need my approved calculator to come out. Yep. 330 divided by what? Shareholder equity, which is 3,560. Which is 0.926. Yep. 0.092696, which is about 9.27%. So that's our return on equity. Right. Then we have leverage ratio, right, which was total assets on SE. Total assets is what? 5160 on 3560. 5160 divided by 3560 is approximately 1.44 leverage ratio. So not too leveraged, not too high. Do we have industry benchmarks? No. It's drivers for 2023 and 2022. You've got the other one, which is profit margin. Well, let's do profit margin last. We'll do asset turnover, which is going to be your net profit after tax. Sorry, it would be your sales revenue, right? Sales over total assets. So see how much money you could be making that year. Should keep the list out just to make sure we get shit right. Asset turnover is sales over total assets. Sales over total assets. Yep. How much money you're making that year? Sales is what? How much money you got from sales? 3 million. It was abbreviate over total assets. 5160, which is 331 divide 5160, which is 0.6607, which is, yeah, 0.600. Maybe like that. Zero 0.61 x. I shouldn't be saying x, but now we have profit margin. Always in percentage, like they say. Profit margin is going to be profit after tax divided by total sales. You got NPAT over sales revenue, which is 330 on 3010. Ugh. That's 0.106451, which is 10.6%. Right. So it's 10.6% times a 1/4 leverage times 0.601 is equals to a 9.72% ROE for the year. For 2022, we're going to try to run through this fast. ROE, leverage. We've got asset turnover. He do equal sign over something. You just go equal sign.
And we can see for the return on equity account, this ratio increased dramatically from 2022 to 2023. Yeah. So now we want to have a comprehensive understanding about the change. So we include the three drivers. Again, as I mentioned, the three drivers should be leverage ratio, profit margin, and asset over. For leverage ratio, it equals to the total asset over total shareholders' equity.
It's very good. The way that they do it.
And the total asset from question 23.
And this number we want to turn into a percentage, right?
So So for leverage ratio, yeah, because as I mentioned before, normally for the financial structure ratio, we do not use percentage. Yeah, we do not use percentage. And also we should run it up to 2020, we just run 1%. Similarly for the 2022, we use the 3936 for total asset, 3936 for total asset, and over total shareholders' equity was 2936.
Yeah.
1.34. And for profit margin, this is another profitability ratio. We need to use percentage. Profit margin equals to the profit after tax over the sales revenue. Profit after tax, we know from the question, and we already included is 330. And the sales revenue should be about 3100 with 10.65%. And then for the 2022, we use 40 profit after tax over the sales 2760, which is 1.45%. And finally, for asset turnover. So the formula is sales revenue over the total asset. And the sales revenue, we just discussed 3,100 for 2023. And the total asset is 5160. Yeah, for the turnover ratio, as I mentioned, it is usually the normal form, no percentage as well. Generally, only the profitability ratios we have the percentage format. And for the 2022, we use the 2760, which is the sales over the total asset, 3936. 0.70. Then maybe we can check whether the calculation is correct or wrong. So the ROE equals to leverage ratio times profit margin times that.
Should equals to both of the profit margin is what? Profit margin is equals to 330. And we want to keep this as a percentage. This as a percentage as well of 40 over 2760. And so check by multiplication. This is equals to this times this times, oh, sorry. This times this times this. 0.09, and that's when we want to increase some values. So we see that's the same, and then we see that that's the same as well. Very, very nicely done, and a lot faster.
At the moment, we just use the leverage ratio as the profit margin as the asset over, which is 9.27. Same to the ROE calculation. For the 2002, same problem.
Okay. Much faster.
And then we need to briefly discuss whenever indicated to your potential investor, you should briefly indicate in your answer which of your calculation is the primary driver behind the change in ROE. Okay. So first, we should discuss the ROE increase. Okay.
Oh. Has
that is the first thing to discuss. ROE increase. Okay. But this increase should be driven by which factor? So for the average, yes, so likely increase.
Most likely.
And for the profit margin, yes, increase a lot.
From a 10x.
But for the asset over, decrease.
Yeah.
So when you discuss the driver, yeah, you don't need to discuss asset over because this one decrease, which cannot contribute to the increase in the return on equity.
Oh, okay.
So what you should discuss is the company has the profit margin is the key driver to increase the return on equity. Then you also need to mention due to the high financial performance or profitability. Okay, you also need to mention because profit margin increase.
Seemingly, specifically meaning that, okay, specifically meaning due to a performance increase for the financial year 2023. The asset turnover decrease, which did not drive the increase in ROE this year, but leverage has also slightly increased. Okay.
Should high performance. And for the you can also add one more sentence, which is for the leverage. The leverage also increased slightly. You can also mention that the company has slightly increased.
Meaning the total asset base has grown a little bit more than the growth of shareholder equity. Something like that.
The leverage ratio due to the increased use of the debt. Okay, so you can also briefly discuss this. But you don't need to mention the asset turnover because it was decreased. So that is the justification. So first you need to discuss the return on equity, and this way increase, and then discuss the driver. Okay, so I will answer just to confirm all that should be rounded to decimal places. The question will tell you clearly how many decimal places we need.
Okay.
Normally 2 decimal places. Yeah.
Okay, that's fine.
Any other question? If no question, let's move on for the next part. Next part for the wishes. I think previously this part is in the big question, but now I think it will be highlighted in the MCQ. But let's still have a look.
How do I crop this image? Whatever. Let's call this like today, 12/8/2026. And we'll bring it out to O section. Okay, let's see, guys. Acquired a bank loan of 750K. The ratio is debt to assets ratio. Treat each transaction independently. The current ratio of the period was 2.4. The debt to asset ratio was 0.67. The return on equity ratio was 4%. All the other ratios were positive. Okay. Oh, okay. So debt to asset is debt to asset. Is that return on shareholder equity? No. Why do they put debt on top? Total liabilities, no? Why is it debt to assets? Oh, it's just a debt to asset ratio, which is total liabilities. So the formula is total liabilities over total assets. Okay, that threw me off. ROE is either the DuPont or whatever you did, with profit margin and leverage being the things. guy. They want me to look at ratio formula, account name and movement, and effect on ratio. Let's make sure for everything we have this type of text. So we have leverage ratio and profit margin. Sorry, they're gonna, right? What's this one? Oh. And then we have debt to assets and ROE. So this is what? NPAT over shareholder equity, total liabilities over total assets. It says that they have acquired the bank loan, right? Which means debt has increased, but assets has also increased. I think there's no effect on the ratio. Yeah. So, or no. If you plus one, oh yeah. Somebody, Kia taught me that, right? If you got debt to assets, and you've got debt to asset ratio was 0.67. Debt to assets 0.67, which is equal to 67 over 100. Okay. And then we said bank loan of 750K. So let's say we just make this plus 75. Plus 75. What is this gonna look like? Right, so we're adding the same thing, but the unit grows. So 67 plus 75 is 142 over 175. Sorry, 275. Which is now 275. So this has decreased. Right, so if debt to assets was larger than 1, then we get, let's say, like a 1.2, right? So it's equal to 12 on 10. So you plus 1, it's 13 on 11, which is, oh shit, 1.18. It still decreases. So an increase in both is a decrease in both. So it says account name and movement. What do you mean account name? Okay. So my assumption would be, this is account name and movement would mean you'd increase in total assets. Oh, okay, and increase in total liabilities. Right? This is debt to asset. Total assets. Yeah, total liabilities over total assets. Total assets. Since debt to is less than 1, increasing both. This is total liabilities. Total assets means there's a decrease in debt to assets. Right? So if your base grew, that means your asset grew as well, and you're able to take on even more like your asset grows. So increasing both, since this means that asset is larger than liabilities, right? Debt to asset decreases, which means larger base can take on more debt at same asset. I don't know how to say that. What does he have to say?
As I mentioned, so generally for probability ratios, we prefer to have percentage, and others we don't have the specific requirement. And also, no matter you use percentage or normal form, even for the probability ratio, you do not use percentage, it is still fine as long as your number is correct, you will still get the mark. So it does not matter. Yeah, you're welcome, sir. Okay, let's discuss this question one by one. Question 1, for the transaction acquired a back loan of 50,000, and what will be the ratio change for the debt asset ratio? So for each ratio, when we discuss whether it will increase, decrease, or remain unchanged, we should first know their formula and also know their transaction. The formula to debt asset ratio is the total liability over total.
Maybe you guys want to watch it like.
Over total asset.
How do we full screen this?
And for the transaction, that loan 75,000, so the cash will increase 75k, and that loan.
Oh, I have to write that specific.
Increase 75k.
Okay, so I have to more specifically plus 75k cash plus 75k in bank loan. So accounting.
Then we can find for this formula, the liability will increase by 75k and the asset will increase by 75k.
Yeah.
Okay, both sides will increase by 75k.
Yeah.
So the ratio will increase, decrease, or no change.
Decrease.
That is a very good question.
That is a very good question.
It's very important and popular, actually, this kind of question.
Yeah, this is a good type of question. Debt to asset ratio is less than 1.
So you have the same change in the numerator and denominator.
Yeah. But the asset ratio is less than 1.
So that has an increase David said no change. Stephanie said no change.
Decrease.
Okay.
Decrease. Both you are wrong.
Around no change. Maybe your tutor did not discuss this with you. Hopefully my students, you should know the answer because I think I highlighted it in week 10 tutorial. Hopefully my students, you need to know, okay?
Decrease.
Does not matter how many we change. Oh, yes, 75, 72, yes, 72, 72. This one does not matter, but yeah. So whether the ratio will increase or decrease
depends on.
It depends on the initial ratio.
Yeah.
Whether the initial ratio
was 1 larger than 1.
Ratio is higher than 1 or lower than 1.
Wait, I'm goaded.
It must be lower than 1 because liability must be lower than asset. So it must be lower than 1. Okay. Okay, if initial ratio lower than 1, okay, and if both numerator and denominator increase by the same amount, okay, liability initially lower than the asset, If they both increase by the same number, so the ratio will be more closer to 1. So the ratio should increase.
Huh?
Okay. So let me give you some examples. Okay.
The ratio increase. Oh, is it because I did... Okay, 142 and 175. 0.81, that is an increase. Since asset debt to ratio, asset is larger than liabilities. Increase debt to assets revenue. It's okay. I made a mistake.
Which I usually use for my car. I should start with my car. Let me just So let's have a look at 4 different scenarios. If the initial ratio higher than 1, okay, let's just assume it is 3/2, so it's higher than 1, 3/2. If both the numerator and denominator increase by the same amount, let's assume both increase by 1, then the new ratio will be 4/3, which will be lower. Okay, and it's close to the more close to 1, so it will be lower. Conversely, assuming the initial ratio is still 3/2 higher than 1, but if they both decrease by 1, the new ratio will be 2/1. So it will be higher, far from the 1. Okay, the ratio will increase. But the scenario will be totally different for the ratio lower than 1 initially. If initial ratio lower than 1, let's assume 2/3. So if both the numerator and denominator increases by 1, so the new ratio will be 3/4, which is more close to 1, the ratio increase. Conversely, if both decrease by 1, the new ratio will be lower, so decrease. For this question, both numerator and denominator increase by 1, and increase by the same amount, and initial ratio lower than 1. Therefore, the ratio will increase, which is this scenario. Understand, everyone?
Very cool, very cool.
Okay, thanks, David. Good. Okay, let's continue. This one is very important, everyone. Okay? Inventory was 30,000, was sold for 45,000 cash. What is the return on equity change?
Inventory worth 30K was sold for 45K cash. And its effect on the return on equity for the year. Okay. And ROE this year was what? Return on equity ratio was 4%. Return on equity, ROE, was 4%. which is equal to NPAT over shareholder equity. Inventory worth 30K sold for 45K cash. Means this is a decrease 30K in inventory, which also means a decrease in current assets, an increase in 45K in cash, which is an increase in total assets, which is an increase in 15K current assets. Okay? 15K increase in current assets. So the asset grew basically without any debt move around. They were able to trade their $30,000 of inventory for 45K of cash, which is great. And they're saying, hey, does this matter for net profit after taxes divided by shareholder equity? What is shareholder equity once again? Shareholder equity is going to be made up of your I don't think there's any change here. This is no change. I'd say this is what I'd say. Not performance related. NPAT, no change. Does the SE change? Shareholder equity base. Total shareholder equity. Oh. That extra 15K has to go somewhere. That shareholder equity base has to go somewhere. Think, Jaden. Would your whole company get bigger? You'd have your TA, you'd have your like CA, NCA, TA, CL, NCL, TL, and then net assets should equals the total shareholder equity, right? So if net asset increase, shareholder equity increase, so this one increase, therefore the ratio got smaller. So this means there's a decrease in ratio.
First, we need to know the formula for the return IFT is the profit after tax over the total shareholder equity. And for this question, it's a very standard question, a classic question. It has two transactions. For one transaction, we should recognize the sales revenue, and another transaction, we should.
Oh my God! It is sales revenue. it's sold. Jaden. Hey, ya. Sold. Plus sales revenue. Inventory is, would you call this? Oh, inventory is like, hey, product. I thought it was like it is super performance related. My bad. Okay, so it should be plus 45k rev. And minus 30k inventory. Minus 30k in inventory. Classic. Or this is what they call COGS. So plus 15k in profit. Right? So increase profit after tax. Right? So in most cases, does this mean I do not look at this at all, and I look only at net profit after tax on SE, right? And currently NPAT less than SE, because yeah. So increase in NPAT means increase in ratio. My bad.
Right, like the extent. So first, for the revenue recognition, the cash should increase by 45k, and the revenue should also increase, which is sales revenue. By 45k. In the meantime, we sell inventory to the customer. Our inventory will decrease, and also the initial cost of the inventory will be the cost of goods sold. So our cost of goods sold, which is an expense, okay, expense, which will end, which decrease the return of profit, which is 30k, and then inventory will decrease by 30k. Okay, now for the total shareholders' equity, for the profit.
Okay, that means inventory is different from COGS. Inventory, COGS is in P&L. Inventory is in balance sheet, right? Same with revenue is in P&L. And this is in CA.
For the profit, it should increase, right?
Yeah.
And we have
profit margin should increase.
And
the most important thing is this should increase.
45k. Decrease, cost of goods sold will decrease return profit. Cost of goods sold is expense, which will decrease profit by 30k. So overall, for the numerator. For the denominator, total shareholders' equity. Will this change or not?
Tell me. I say no.
Total shareholders' equity, will this one change or not? Anyone want to discuss?
Will total equity change or not? Well, your net asset did increase, right? It's that correlation between the balance sheet and the P&L where your net assets should always equal to your whatever, right? Let's think again. He's asking the good questions. This is a good revision. Take a look at okay, still an increase. Right. 4/100 plus 1 plus 1. 5/101, which is what? 4.9. So yes, it's still an increase.
This is another very important question. Will your projection include the revenue and expenses? Will the shareholders actually change or not?
Yes.
Anyone?
Yes.
You can either turn on your microphone and speak, or you can type your answers in the chat. It will decrease. It will change, and the cost of goods sold will decrease the shareholders equity, and the sales revenue will increase actually. This is actually another question we discussed in the week 4 additional question. Hopefully your tutor has discussed this with you during the class. So for any revenue expenses, they will affect the shareholders equity because the shareholders equity equals to the share capital plus opening balance of return profit plus revenue minus expense and minus dividend.
Jesus.
So definitely for this question, the tax revenue will increase the shareholders equity and
shareholder capital plus. What do you say? SE is made up of.
This is L. So for any revenue expenses, they will affect the shareholders equity because
any rev or expense change affects SE.
The shareholders equity equals to the share capital plus opening balance
return profit
of return profit
plus
plus
cash
revenue minus
plus rev minus.
expense and minus dividend. So definitely for this question, the sales revenue will increase the shareholders' equity and the cost of goods will decrease shareholders' equity. Overall, the shareholders' equity will also decrease by increase by 15K. Increase by 15K.
Interesting.
Now we have another question, another scenario. Both numerator and denominator increase by the same amount.
Return on equity ratio was once again less than 1. It's always less than 1 usually. So the effect of the
Then we also
increase.
need to check for the initial ratio, whether the initial ratio higher than 1 or lower than 1. So return on equity, which is the profitability ratio, as I mentioned, all the profitability ratio should be lower than 1. But that is the question also gives you the information. Standard asset ratio 0.67, return on equity 4%. They are all the lower than 1. So for any scenario lower than 1 initial ratio, they both numerator and denominator increase by the same amount, and ratio will increase.
Nice. Good revision.
Any questions?
Nope.
If no question, let's move on. Declare a dividend of 500,000.
Declared a dividend of 500K. And that into profit margin. Do you pay your dividends? You'd pay your dividends after profit margin, no? Right. I like this size, maybe a little bit smaller. Is this what we were doing? Yeah. Sorry. So declared dividend of 500,000. But so this is performance. You'd go through your whole process for the P&L. And then you'd go to the opening closing balance, right? I need to access that. Google, no Moodle, no Notion. We will access that week 4 maybe. what is that? Share capital plus opening return profit plus revenue minus expenses minus dividends. Balance sheet is current assets plus non-current assets is equal to current oh, okay. When you're looking at this, that's where it's like net assets is this minus this, and so you're left with shareholder equity right here. So yes, keep remembering that net assets is that. We remember share capital plus opening retained profit for the day, for the week, for the month, plus some revenue minus some expenses, subtracting some dividends. So if we declare a profit margin, I don't think anything happens. Opening statement of retained profits. So this is not the same as profit margin, right? Because this is inside business, inside performance. So this is money that gets decided. Hey, do you want to pay dividends on it? Should we use this for capital or whatnot?
For dividends, everybody, you need to know there are two steps for dividends. Okay, two steps.
Two steps for dividends.
For step one, okay, what we should do is we declare a dividend, but it's not paid. So for this scenario, the return profit, okay, will decrease, and dividend payable will increase. It means the company has the obligation to pay the dividend.
Statement opening and closing. I've got a question on financial ratios.
Go on.
So, just to be clear, let's say a company does its accounting, it has a P&L. After the P&L, it has the kind of net profit after tax, right? And then after you take that net profit after tax, do you add it with the profit that you already have in the company so that you can get a larger opening statement of balance? And then that's where you would kind of declare if you're going to pay a dividend or not. And then after, if you pay the dividend, does this mean that you record that you lose, you deduct that many from the dividend, deduct that much of the dividend money from the retained profits, and then if you add dividends payable, is that in the balance sheet?
Let me walk through that carefully. 1 second. Okay, so after your P&L, the net profit after tax gets closed into retained earnings in equity. So think opening retained earnings plus this year's profit minus dividends equals closing retained earnings.
Wait,
Dividends
start
don't
again.
just
Start
happen
again.
on
Start
their own.
again. Slower.
Yeah.
Just
After,
yeah.
sure.
Like ask me every
After,
single second.
sure. After the P&L, we take the net profit after tax. That figure gets closed into retained earnings.
Closed
Are you
into
with me so
retained
far?
earn. Closed into retained
Yeah.
earnings. So
Right.
do I just say therefore that year's thing is closed retained earnings? Okay.
Correct. Yeah. So you start with opening retained earnings, then you add this year's profit.
Which is the closed
Are you with
retained
me?
earnings?
No, this year's profit, and then subtract any dividends you've declared.
But you just
Are
called
you with me?
what do you just call closed retained earnings?
Yes, you add those all together.
No.
And
Wait,
after adding and
wait.
subtracting.
Wait. So
Okay.
there should be two different sheets, right? One P&L, one opening statement sheet, the balance sheet. Is that so? There's that three. That's three total.
Let me double check that. Not exactly three different types. Think of it as two main ones.
Yeah, I know.
P&L.
P&L and the balance sheet.
That's exactly. So the P&L gives you the profit. Then that profit rolls into retained earnings within the balance sheet under equity.
Sorry, 1 second. So,
Sure.
net profit after tax from P&L rolls into the balance sheet.
Exactly.
So
more specifically,
balance sheet
to retained, yes, specifically to the retained earnings line within equity. Does that part make sense?
So in share equity, you've got share capital, you've got what is it? Retained profits,
Exactly.
opening retained profits.
Exactly. Perfect so far. Now you add this year's profit, then subtract any dividends you declared. That gives you the closing retained earnings. Are you with me?
1 second. So you add the new net profit after tax, then if you want, you can deduct some dividends.
Correct.
And then would that be in the balance sheet as well, or how? Or is that like outside in that opening and closing statement where you write, hey, so my opening retained profits is now going to be the last year's retained profits plus the net profit after tax this year, right? So is that the opening one? Is that opening? Hello? Hello? Hello?
The dividends, if declared, get deducted from retained earnings, which shows up in the closing equity section on the balance sheet. Does that fit with what you're picturing?
Say that again.
And if the dividends declared, so if a dividend's declared but not yet paid at the reporting date, that unpaid amount shows as a liability.
Okay.
Called dividends payable.
So dividends payable is a liability if I did not pay. And then once I do pay it, I'm gonna take away the dividends payable from the liability. I'm gonna probably deduct cash, right? And then do I just take that money out of the business?
Let me double check that for you. Yeah, that's exactly right. When you pay the dividend, you debit dividends payable. That clears the liability. And credit cash, so cash goes down, right?
Yeah.
It doesn't hit retained earnings again on payment because that reduction happened when you declared the dividend.
Valid.
Does that line up?
Valid.
So declaration.
So there's only some misconceptions that I do need to know. That's the difference between opening statement of retained profit and closing statement. Like what are those? Is it opening and closing balance? Yeah, opening balance of retained profits.
Yeah. Right. Opening retained profits is just last year's closing number at the start of this year.
Okay.
Then you add this year's net profit after tax, subtract any dividends declared, and that equals your closing retained profits, which you show in equity on the balance sheet. Make sense?
Wait, so you open it and then you add all that net profit after tax, then you close it.
Exactly. Start with opening retained profits.
So that's
Add
the
net
that's the
profit
money
after tax.
that's the money last year.
Right.
Then
Exactly.
you add net profit after taxes,
Right.
and then if you want, you can deduct dividends on paper. You say, "Hey, I'm gonna pay a dividend," right? So
Exactly.
I'm gonna subtract that from my retained profits. But if I haven't paid it yet, I'm just gonna say, okay, well there's 500K I've set out for dividends payable. That's in my liabilities.
Exactly. So yes, you reduce retained profits when you declare the dividend and set up dividends payable as a liability.
Wait, so retained profits is the bottom after you saying opening statement of retained profit from last year, right? So opening statement of retained profit from last year plus net profit after tax this year gets you retained profit for this year.
Exactly.
And then you take
Right.
so you take that bigger number, usually bigger number if that year you're profitable, and then you divide you take away the dividend amount that you want to pay, right?
Exactly. Right. One tweak. It's not like an average or a split. It's just opening plus this year's profit minus dividends to get the closing figure. That's all.
Okay.
Then the closing number sits on the balance sheet.
So the closing number sits on the balance sheet. Oh, okay.
Yeah.
It sits on the balance sheet. But why do they say shareholder equity is share capital plus opening retained profit? Is it just because it's like every year you're doing something, you're doing the new one, so you have to take the closing one for the year before and you just call it opening one for this year?
Let me double check that handoff. Yes, that's exactly right. Last year's closing retained profits becomes this year's opening balance. Same number, just labeled for the new year. Then after you add profit and subtract dividends, the new closing retained profits goes into equity on the balance sheet alongside share capital. That clear?
Yes, thank you so much. That was actually very clear.
Glad that worked.
Opening balance of retained profits. Year prior plus NPAT this year minus dividends equals new this year closing balance of retained profits. Then
Exactly.
so either we go back into the balance sheet, right? And
Right.
either we go back into the balance sheet and we pay it with cash, or we pay it with with or we pay it later.
Let me line that up 1 sec.
That's okay. It's okay. I got it.
With it in the future. And then for step 2, pay the declared dividend. And if we pay the declared dividend, so the dividend payable
Cash.
will decrease, and we use cash to pay. Cash will also decrease.
Okay.
For some questions, we just combine them together. So the question is, oh, the company declared and paid a dividend. So we can combine together. For this question, we only declared, not paid.
Okay. So if they only declare and didn't pay, then we have to say what happens here. So what happens if they declared doesn't mean paid. Doesn't mean paid. So this declared dividends and also effect on what? Effect on profit margin. What? Doesn't affect shit on profit margin. Oh. Okay, but accounts and movement. Well, for the accounts and movement, we have minus 500K off retained profits, right? We have plus 500K worth of dividends payable. And our profit margin is net profit after over sales, right? So honestly, no change. No change. And then we'll say because dividends are paid from retained profits and after net profit after tax this year. Okay, that's my final answer.
Example for this scenario, for this question, we have the return profit decrease
yeah.
and the dividend payable
increase.
will increase, both by the 500,000. And for the ratio we want to check is profit margin. And profit margin is equal to the profit after tax over the sales revenue. And for this question, profit, actually no change because we only have dividends payable with the profit. For sales revenue, no sales. Therefore, for this question, there should be no change.
Nice.
Let's move on. Any questions for this one, number 3? Okay, the next question. Receive a deposit from customer of $10,000 for a project that will come up in the next term.
Received a deposit from a customer of 10K for a project that will commence in the next financial period. That also means we get some cash, but we have to call that a deliverable, right? Deliverables payable or something, or deliverables in our liability section. Yeah. Is there any change in the leverage ratio? What's the leverage ratio? 质疑，我操你 mother. Sorry, that's not what I meant. 质疑, I love you. I'm supposed to say deposit 10K deposit for next year or / next financial period. Bang. Effect on what? Leverage ratio. which is defined by total assets over shareholder equity. Okay. So 10K deposit means plus 10K cash. That's it. Minus 10K in, or plus 10K in deliverables payable, right? Which is an increase in current liabilities, which is an increase in total liabilities. Same with this one, which is an increase in current assets, which is an increase in total assets. Right, so that does change. Does the share equity change? Ooh. So no rev gets recorded because no, yeah. That's it. So total asset increase and shareholder equity remains the same, and ratios are positive. So leverage ratio has increased. That's it.
Financial period. And what's the impact on the leverage ratio? So first, we need to know what is the leverage ratio, how to calculate. So leverage ratio is total asset over total shareholder assets. And for the received deposit, which should be the unearned revenue, and the received deposit for cash should increase by 10K, and then unearned revenue it also increased by the $10. So everyone, you also need to know unearned revenue is current liability. It means the company has the obligation to provide service or goods to
unearned revenue. Could I? Hello?
Yeah, I'm here. Go ahead.
Could I call unearned revenue the same as deliverables payable?
Let me check. Not exactly. So unearned revenue or deferred revenue is the proper term. It is a liability because you owe the customer goods or services.
But you can't call it deliverable payable? Oh, okay. So it's not because I pay, right? It's because I have to do it or I have to give it to them. So it's either a product or a service.
Exactly.
Okay.
Exactly. Yeah. The liability is for the performance. So you don't owe cash, you owe the service or the product.
Deferred revenue. So owing the service or product. Thank you. That's it.
Exactly.
Bye-bye.
Sure thing.
Cái này giống call a friend. ABC Limited is a business of waste disposal having 800 million in debt outstanding at a market value, book value of equity of 20 of a lot of money and 100 million in cash. ABC is the business of waste disposal. 800 million in debt outstanding. Book value of equity of 2,400 million. Okay. Okay, these are important. Valuation is important because we don't remember shit about valuation. Let's remember what we do currently know about valuation, which is there's MVE and there's EV, right? And this is equals to market value of equity plus all the debt that the company has, and you take away all the cash. So that becomes like the enterprise value of the company. This is equals to this is the same as the market capitalization or market value of capital or market value, bunch of shit. And then with these you have you have these multiples. Market price per share, market cap. So PE, PB, PS. PB, price to book, price to equity, and price to sales, which is MVE over book value, right? You've got MVE over equity value. You've got MVE over sales. This one is EV over EBITDA, EBIT, EV over EBITDA, you've got EV over sales. So it says that we have this company ABC, and it has a 800 million in debt outstanding. So debt of the company is 800 million. It's got book value a lot of M's, cash, a 100 M's. Peers trade at 6 times EBITDA. So peers trade at 6 times EBITDA. So we see right away it's a PE and PS. Peers trade at 6 times EBITDA. Fuck does that mean, bro? This is such a good question too. What the hell? Okay. 6 times EBITDA. Does that mean EV over EBITDA is 6? Does this mean that PE ratio is 1.6 and PPS ratio is 13? And then we're looking at the numbers. $700 million in revenue, 650 million in earnings before interest, tax, depreciation, amortization, 450 net income. So that's NPAT, and number of shares, 100 million shares. So right away we can find something in terms of market value. We want to find the enterprise value. We want to know the market cap. How would I find the market cap? Market cap. Okay, I could find the market cap like this. If I have the PE multiple, I know the PE multiple, right? PE is what? Price
market value, book value of X.
Price to earnings per share. I need to piss. I can't think. I'm trying to piss. Yeah. Bro, sky's the limit at this case. It's so clean. But it's getting really good. It's getting really good. Like the app is getting really nice. The app is really nice.
you don't really like you don't see how nice the videos are until it's like your own thing. The effect themselves, I know it. What is it? What do you mean how I came on? Well, that's it. I came on. Use it.
equity 2,400 million, 100 million in cash, and PR traded at 6 times EBITDA, 1.6 times of the book value of equity, and 13 times the earnings. So the EBITDA is forecast to call for the 700 million in revenue, 650 million in the EBITDA, 450 million in the net income this year, and also there are 100 million shares outstanding. So question A, using the CCE method, what is your best guess of the first share price based on the earnings?
Price to earnings ratio. PEPBP 13 times. How to find market cap? Current share price by total of shares. Market cap. Okay, so market cap, or MVE, is equals to number of shares times price per share. We have a PE, price to earnings. Do we have net profit after tax? Yes. 450 million income is equals to 13. So, because book value I'm close, see it. PE multiple is price to earnings multiple. That one, PE. Earnings is not equal to sales. So because PE is 13 is equals to market cap over net profit after tax. Share price based on earnings. Okay. So we get 13 times 450 million of market cap. And that means market cap is equals to 5,000 million. Then market cap divided by what are earnings per share? Having 800 million in debt outstanding at market value. We still don't have market value, right? Do we notice that PE multiple market cap divided by net profit after tax gives us a P multiple of 13 times, right? And if you divide everything by earnings per share, and would we be able to find the share price? No. Market cap is equal to, okay, if MVE is this, share price MVE number of shares. So it's 5 this million over 100 million $583 per share. Expensive, bro. One triple two.
Okay, for the recording. CCA method. What is your best guess of the first share price based on the earnings? Because of that. Yeah, for CCA method, what we do is we usually assume the similar company they use the same model. For this question, yes, we give you directly. So because for the multiples, we already know the multiple we want to use is for the EBITDA is 6 times, book value is 1.6 times, and the earnings is 7 times. So part A is just the PE. P is market cap over the earnings. Okay. So we just use this multiple. Therefore, to calculate the inside, so we want to calculate the share price. But for share price, what you should have learned is equals to the market cap over the number of shares. Okay. And from the question, we already know the number of shares, 100 million. So you only need to calculate market cap. Okay. First, we know the target for should be ABC limited. Okay. A, B, C, D, okay. And we want to calculate ABC limited the market cap and also share price. And for the market cap, we also call it inside market cap, usually we call it. Okay, it equals to the interestingly very similar to your Mood 5 discussion about this 5 additional questions, which you should also done in your group assessment for from B. So we use E from the here, and then times the net income from the ABC. Okay. So the E here is 30 times. Net income, which is earnings. Earnings, net income, they are the same thing in this course. Net income or earnings is 450 million. Okay. So it's equal to the 13 and 450 million. Okay. So it should equal to 13 times 450, which is 5850. Okay, but it's the current is million dollar. Okay, that's the calculation for the implied market cap. Then we know the implied market cap, and we know the number of shares outstanding implied share price, which is outside the gap. So this share price is for ABC. It's equal to the implied
Your cap divided by number of shares.
market cap, which we calculate in the step 1, and then divided by the number of shares outstanding for the ABC. So it's equal to the previous one is 5850 divided by the 100 million. Which is equal to this one divided by 100. So $58.50. It's $8. Okay, $8. Okay. Any questions for this calculation? If no question, let's move on for the PB model.
Okay. And if PG here is equals to 1.6, PB. Price to book value is market cap over book of value of equity. We want to find the share price. Book value of equity is that. I don't think we could use. $2,400 times 1.6 is right. Right. Then and if what's the last one? EV over EBITDA. We have debt, we have cash, we have book value, we have EBITDA. How do you find enterprise value? Oh, we can find market cap using 6 times EBITDA. Okay. So EV over EBITDA. EV over what? EBITDA of 650 million is equals to 6 times 650 is equals to EV, and EV is equals to MVE plus debt minus cash is equals to left hand side is 3 times plus debt. $700 million. Okay.
We have a very similar step. So for the implied market cap, A, B, C, and this time, here we need to use PB here, okay? Because we ask you not to use the PBF method to calculate the share based on book value of active. So PB here, we also times the book value of active, and the first question is 2,400 million. Yeah. ABC. Then I will continue to discuss the flow part.
Nice. After this, I'm going on a 5-minute walk.
In the meantime, if you have any questions, either on your microphone, let me know, or just put your question in the chat.
Okay, that one wasn't too hard. So the goal here was to use info to find implied MVE based off of certain peer multiples.
Also, therefore, we need to know how to calculate each type of multiple one by one. For active multiples, we should use 2 steps, but for independent value multiples, we should use 3 steps. Okay, now I give you about like 1 or 2 minutes. You can have a look at the questions, and then I will continue to discuss the British flow part.
Maybe we can.
In the meantime, if you have any questions, either on your microphone, let me know, or just put your question in the chat. Could you explain why it's called active multiple when the ratios are using market cap? The market cap is market capitalization, and another name is market value of equity. That's why they are active multiples. As I just mentioned, market value is same as the market value of equity, same as the market value of capital. I think the same as another case, the capitalization. It's the same thing. Yeah. I think we also discussed this in both lecture and tutorial in this class. So they are exactly the same. That's why we will discuss market cap is same as the equity component, so equity model.
I need to walk. Almost done with this video.
They also have their maybe the
Free cash flow.
Earlier later, and then if you
Ooh, free cash flow is fucked. In millions, fiscal year inventories is that. Accounts receivable is that. Okay. Free cash flow, we're looking at change in cash flow every single year, change in net operating profit. Change in market capital every year. Free cash flow is also like you include depreciation. And amortization. If there's something we want to learn about FCF, it would be that one equation. What would be the equation? Net operating profit after tax plus the depreciation, subtracting capital expenditure and net working capital. Subtracting. If net working capital increased, it drained cash. So you have to subtract. An increase in operating net working capital, does that mean if there are more accounts receivable and that we call it revenue, we have gotten any money? So if operating net working capital grows, that means there's more money that we haven't gotten. If it is a larger positive number, that means we recorded more accounts receivable. But it also means we got so much more money stuck up in the bank. Okay. So it increased that year, so there's too much money. Increase in operating net working capital means we've got more people that we expect, but money hasn't hit the bank. Okay.
We have questions, you can media. Yeah. So for the free cash flow. Okay, this one we also ask you to run your answers to two decimal places. We have several tables here. We have the operating asset, operating liability table, current operating asset, current operating liability table. We have the run your cost depreciation EBITDA CapEx table, and we also have the EBITDA numbers table. Okay. Part A, we ask you to calculate the net operating profit after tax in 2028. Net operating profit after tax. What should be the formula?
EBITDA times tax rate, or times 1 minus the tax rate.
Net operating profit after tax, and we discussed it in the first half of this revision workshop. Okay. net operating profit after tax is equals to the earnings before interest and tax, then
EBIT 1 minus
1
tax.
minus the tax rate.
EBIT.
So for this function, we have EBIT, we know clearly is 121, okay? Meaning and time.
Okay, so they want me to calculate this. Equals to 121 1 minus 0.29. $20.28. Let me do it for a year. Net change of operating capital. Net working capital. Accounts. 3. We usually want accounts payable to be high and accounts received to be low and inventory to be low.
1 minus the tax rate is 29%. Yeah, 29%. Now, the tax rate that's not operating profit after tax, which is the DBS, which is the 121 times 1 minus 0.29. So it's $85.91. And we use the millions of dollars. Millions of dollars. And for part B, we ask you to calculate what is the change in operating net working capital in 2028. To calculate the change in the net operating working capital, we need to know 2 years.
Yes.
The question asks you to calculate 2028, but you need to calculate both 2028 and 2027. For the net operating working capital, okay, it equals to the cash. No cash. It equals to the inventory, account receivable plus inventory minus the account payable.
Accounts receivable plus inventory minus accounts payable. Oh, is that? Oh, that's in our ratio list. Account receivable plus inventory minus account payable. Accounts receivable plus account payable. And subtract T from T1. T1 from T. So start with okay, so accounts receivable plus inventory minus accounts payable. Accounts receivable 5.2. 5.2 plus inventory 25.8 minus accounts payable 19.8. $4.6 plus so 11.2 minus 10 is equals to 1.2. So a net increase this year. just sorry equals if it is positive, this means we have more cash tied up this year, which is not as good. FCS is equals to EBIT NOPAT plus depreciation minus capex plus change in working capital. NOPAT plus depreciation for this year is 3 minus open bracket capex 5.3 plus general capital.
Change in the X3. And we have the change in that of the working capital from before 1.2, so we should minus 1.2. Now for free cash flow, we use 121 times 1 minus 0.29 plus 3 minus 5.3 and minus 1.2. So we got $82.41. Oh, so all of the results should be in US dollars. Okay, any questions?
No. That's the bulk of revision, by the way.
Okay. Yeah, I think that's all the questions I want to share with you. So, as I mentioned before, we also provide you with a lot of questions. Okay, so please try to complete all of them 2-3 times and make sure you are familiar with the questions. For this material, I will upload them shortly on Moodle later. Anyone have any questions? If you have about academic life, anyone have any questions, and we'll be right happy to answer questions. So the account receivable decrease by 30,000. We both are account assets. Together, there will be 0. They cancel out. So that's not going to change. Okay, 2 times that all good. Already the whole everything is excellent. Excellent. Yeah. The end.
Thank you, everyone, and I hope you enjoyed the session.
Nice. It was a good session. Thank you to the tutor. We are going to poop. Right. Okay. The following shows the balance sheet accounts for Sydney Company at 1st of July. Bank. What's DR? DR and CR. Bank accounts receivable, prepaid rent, property and equipment. Accumulated depreciation is that. Accounts payable is that. Bank loan is that. Share capital is that. Retained profits that. The following transactions took place during the year ending 30th of June 2023. We recorded sales of 650K, of which 500K constituted to cash. We collected 325 from accounts receivable. Okay. So this is the year prior. And then it ended on this. So it was exactly 1 year afterwards. And we need to prepare the income statement for our final year. The prepaid rent of 10 grand at 1st of July for 2 months of rent. In August, the company prepaid rent depreciating on property is 45K per annum. An insurance policy was taken out for the first time. Mid-month, an amount for 12 grand was paid for 12 months, running from that to 1 year from that. So we've already used up, 6,000 of that. On 30th of June, the directors declared and paid a dividend. Declared and paid, so, okay. And 10 grand of wages relating to June have not been paid and need to be accrued. Paid accounts payable balance in full. Paid accounts payable balance in full. Record each transaction in the table below. Could we increase shit here or no? Okay, we're gonna record the transaction. Wow, this looks like a pain in the ass, by the way. We're gonna see what we kind of did on the week 2 homework. pretty fun to me. First transaction is we purchased inventory from a supplier worth 250k cash. How should we record this? We should record the thing. Do I have a video of me filming right now? Yes. See if I can. Okay. So purchased inventory from suppliers. I think everything. I'm just gonna make a comment. Inventory increase in value, decrease cash, same value. Okay. So transaction, we're gonna have 250k and cash. Where's cash? What's PPE? What is PPE? Property, plant, equipment. Bank. Account, loan, share capital. Bank. Fuck is bank mean? Bank. What is CR and DR in accounting? Debit and credit. Does bank DR mean that's bank debit, so the cash you have? Huh? Yo, does this DR and CR mean I'm showing you the balance sheet accounts for Sydney Company? DR, I'm assuming, is debit. CR is credit. So does that mean we have 300k in... I mean, this is for the company, right? So this is balance sheet facing the company. Would you say that we have 350k cash, 100,000 worth of inventory, and the ladder? And then the other one is like all the credit is like the stuff that... Or is credit the stuff that we already have, that we have? And let's say if I want to take out cash, do I take it out of share capital or do I take it at the bank? Okay, if the company pays cash, we will reduce the bank account. because that is the debit balance we have. Okay. There you go. Then we're recording sales revenue of 650K, and 500K came from cash sales. So we record it. $500K came into the bank again. Recorded sales revenue, 500K from cash. I assume the extra 150K needs to be some form of accounts receivable that we remember that we account for. Also, yeah, no need to talk about any expenses yet. Just record the new sales. So we got 500K worth of new sales, of which we have an extra 150K from accounts receivable. Collected 325 from accounts receivable. Okay. Transaction 3, right? Collected 325. We will deduct 325 from accounts receivable and turn that straight into account for the cash we've collected. So minus 325 and get an extra sum of cash, which is 325. Cost of goods sold was that. Paid. Do we want to pay it, or have we paid it? We haven't paid it. It just says cost of goods sold. So we are not paying it yet. It did not say paid. It said cost of goods sold was this. So we will record it as a account payable. Transaction 4. Accounts payable. $250K. 225. Paid interest expense of $5,000. Interest expense. Is there a place where we have interest expense? Accounts accumulated depreciation of plants. Accounts payable, wages payable, share capital, retained profits, prepaid insurance. Yeah. Or was this a deduction in inventory? When you're looking at this, they're saying this transaction cost of goods sold is 225,000. Is this a deduction in inventory, or is it a record of accounts payable? Buy inventory but haven't paid. Sell inventory. Inventory decreases. Okay, cost of goods sold. Wrong. Right. Yes, it's a good sold. So reduce inventory. And it says paid interest expense. For what? Taking debit out of the business. Paid wages of 80K. So not even wages payable. You just take 8K off. Prepaid the rent for 2 months rent. So you prepaid the rent at the start of the year And then in 6 months, no, not 6 months. You paid rent for 10K for 2 months. That means month of rent is 5K. And you paid it until the end of August. And it says in August the company prepaid rent of 60K for September to August. Okay. So they prepaid 80K with, 70K with the rent. Is there anything that we need to think about? Prepaid rent of 10K here. Prepaid rent of 10K. And another 60K with the rent? Is that what you want me to do? Transaction 6. Pay 80K with the wages. Transaction 7. Huh? There you go. The prepaid rent. They paid till August 2023. Whatever. Just pay it. 60K rent. Mm-hmm. Following that, how would I record this? Would I just record it directly as 60,000 being accounted for prepaid rent and then taking another 60K out of the bank? Depreciation is 45K a year. Have we accounted for depreciation? Property is another 45K. $45K. insurance policy was taken out for the first time, an amount was paid for 12 months, running from 1st of January to 31st of December. So 1 year. We needed to record that as well, right? Insurance policy. Prepaid insurance. What if it was like prepaid insurance, you know, and it was like paid for every few months? How would you record it on a table? Would you record the insurance that we've already used up, or and split it up, or do you just like account for the 12,000? See, then that's prepaid rent. Then I'm assuming that's the same for rent, right? Would if I had like, I spent 60K for rent somewhere within the year, and at this time, end of the year, I would show that I've used a certain number of rent from that already, right? And then the rest I have as like leftover rent. Credit paid rent. That's what I think. I think this is prepaid rent, so we have 60K with a prepaid rent. I think for this, it looks like it has prepaid rent for two more months prepaid rent, and we've exhausted the 50K already. So we still have July's rent and August's rent where we've already prepaid. So maybe that's 10K left over in the rent section. I'm assuming it's like 50K here and then like 10K here. Same for then we have to accumulate depreciation for 45K per annum. So just take out 45K this year, or record it as a... For depreciation, do I just record it as the annual thing, and I just record that I have to lose out on it, but no cash is being spent, right? So it's just a open bracket and then the set number, I'm assuming. an insurance policy was taken out. It was paid running from January to December. So insurance, right? So we spent 10 grand on insurance. Oh no, 12 grand on insurance. And for the prepaid insurance, we got 12 extra thousand. But we basically how do they want us to record that? Or is it like this? Where it's like, you got 60 grand. Wait, no. Just, I'd say like 60 grand here, right? And then you still have, and then you spend 50 grand over the course of whatever years. And then this bottom one here is, you've got 12 grand. And then it's, I mean, that you still got like 6 more months of shit, right? We're preparing for 6 more months of insurance policy that's free. So I would take away 50, I'd take away what, 6K? 10 is the directors declared and paid a dividend of 50K. So they declared and paid a dividend of 50K. I will means that on June 2023, so is it today they declared it? Yes. So they declared and they're gonna pay it. So retained profits gets cut by 50K. I recorded it as an expense, but no cash was taken out. Insurance policy. We've spent 6K. The 6K on 6 months of rent of insurance. So we have 6K left over. On June 30th, the directors declared, alright, took it out of, I took it out on retained, out of retained profits. 10K in wages relating to June that have not been paid and need to be accrued. So accrued is just here, right? Wages payable. 10K. So record and amend it. Don't deduct it. It's an account in the liabilities section that grows. Paid accounts payable balance in full. So basically saying we take 60K out from bank debit and pay down the accounts payable. Okay, that's my thing. I'm just going to check first with Moodle to make sure that we have something. Okay. Can everybody see the statement? I can see the statement. 350K, 200. First account we made was correct. Second account we made was correct. Third account we made was correct. Fourth account that we made needed to increase into retained profits. Every account we needs to have retained profits. So we need to always balance it. So if we do have an increase in assets, no decrease in liabilities, we need to basically increase and accrue our retained profits. Okay. Let's just make sure we can do that. This means that this month, 650K, okay, that we have not included, $225,000 of cost of goods sold is a decrease in inventory space. That's it, right? Decrease in inventory space has nothing to do with us, no? Okay, so they took it out on that as well. They took it out on that as well. Minus 250K. What else they take it out? Bank is 5K here. Let's make everything in this line red. This is 5K that we need to account for. $80K that we need to account for. $60K that we need to account for. Or what? How did they do this? We used up the rent, then we prepaid for new rent, then we used up rent again. Okay. So used up the rent, prepaid the rent, used up the rent. Valid, super valid. This cell recording that we've used up the rent, the prepaid rent somewhere in the year. Alt H4. Alt H4. No. Okay. This is where we record a new transaction where we spend 60K and we lose another 50K because we spend that 50K again. Yeah, so good. Deduction of another 50K is good because it's been 10 months since that day that we've repaid, so we've got 2 more months or 10K left worth prepaid rent. 45K for depreciation, which should affect also here. Here, we also don't account it in the retained profits because we switch the cash into an asset, which is the prepaid rent, so it's balanced. Okay. Okay, 45K here. So 45K worth of accumulation. Retained profits is weird, eh? If we don't incur anything, you have to think like a business. Oh. 12 grand. So we we spent 12 grand on insurance and we used up 6 grand, which is fine. Then 50 grand for transaction 10. We needed to take it out of cash because cash and retained profits are basically like going through the same channel. Tons of errors. And a lot of the errors come from not balancing the sheet, right? Like this wages payable means I have to pay wages. Oh, never mind. I just accrue. Oh. You accrue it. Here, yeah. Like for this, if we accrue something that we don't pay, we have to deduct it from retained profits to balance it. $66.60K. Okay, tons of errors, tons of mistakes. It's okay. Prepare an income statement for the year end. Which transactions are going to be important transactions? So do we copy this page? clear formatting. Purchase inventory. What are expenses? Cost of goods sold. Or no, not really. Profit and loss statement comes directly from this one, right? Right? That's sales revenue. So you just account for sales. Then you account for expenses. Just expenses, interest, cost of goods sold. Do we care about the purchase of inventory? No. Right? I think we just like include these. Do you care about rent being paid? Do we care about depreciation costs? Depreciation expenses. Yeah. So don't care about cash. Just care about what you spent money on, what you lost money on. Sales, gross revenue, expenses. Would you call that inventory expense? Hey, would you record purchased inventory as part of an income statement? Because it's basically an expense, right? Would you record it as an actual expense directly associated with the performance of the business? I'm assuming yes, right? Or no? Not when you purchase it. When you sell that inventory, it becomes cost of goods sold. You don't record this as an expense. You should only record this as an account in the balance sheet, as an asset and cash, so no expense. Depreciation is an expense. Insurance. I'm assuming you would record like rent expenses, you'd record depreciation, you'd record insurance expenses, and wage expenses, right? All expenses, and it doesn't matter if we've paid them or not. Basically, if we've accrued them or not, right? The P&L cares about when the expense was occurred, not when the cash happened. Okay, so we record the sales revenue, right? How do we record anything else? No, we don't record dividend. We do record this. And do we pay accounts payable? Let's say I paid accounts payable balance in full. Is that an expense? Oh. Paid doesn't mean paid already, so it needed to be recorded when it happened. This is just the after effect. And once again, I'm assuming that dividends are not an expense. I'm assuming wage expenses that are accrued is an expense. I'm assuming rent. If it was prepaid rent, it would still be an expense for this year, right? Because we did pay rent and cost of goods sold and interest expense and wages. Or do we record that we paid the interest expense or the wage, or not at all? Also, would there be a correlation or a connection? Let's say if I already accounted for my, like I have a table of my accounts. Let's say, is there a certain shortcut or a certain way to think about it where only if I record it in my retained profits that could be an expense, or that could be an that could be a revenue. I'm assuming like if I prepaid rent and I got the rent as prepaid deliverable, then do I need to record that as part of my retained profits? I'm assuming no, right? Then is that part of my P&L? Then for the year, if I paid 80K worth of wages, that's a wage expense, right? But if I prepaid 12 months of 12 months of insurance, but it's only been 6 months, then I only record 6 months of expenses. Depreciation is an expense, I'm assuming. I also record that. 10,000 of wages that have not been paid are also a wage expense, right? So I don't care if it is paid. It was accrued, so I need to record it, right? Oh, this one's weird. This one is like 60K worth of rent expenses, basically, used for this year. Because it was actually used this year. Okay, so I have to do go sales revenue, and I'm gonna record 650K. Then I'm gonna record COGS, right? 225,000. Expenses, and I'm gonna have interest expense. That was a interest expense that I need to pay, so I paid. Then I'm gonna pay my wages expense, which include paid and unpaid, which is 80K. Sorry, yeah, 80K. And oh, that means I should just this is 90K. So both 80K that accrued and 10K more accrued at end of year, right? Prepaid 60K rent expense, 60K in total for the whole year, right? 60K in total for the whole year, regardless of prepaid or not. We spent 60K on rent. Depreciation, insurance expenses, and what do I get? I get Ooh. Look, so many bad problems. These expenses have to go down here. That's number one. Right? I have to take that out. Right? Expenses, wage expense, depreciation. And then depreciation is EBITDA. EBIT. Interest, tax, depreciation, amortization. Earnings before. So we don't have any. Where's the tax? There's no tax rate. Do I say that this is a depreciation? Depreciation. Wait, I'm starting. I need to start with sales revenue and COGS, right? And then we get our gross profit. And then we have our expenses with a list of expenses, right? Then we have our net operating profit, right? And then we'd have our our interest tax, right? Interest and tax. Where do we put depreciation? But I'm assuming taxes. Oh, EBIT goes first and EBITDA goes. EBITDA goes first and EBIT goes after. EBITDA first and then EBIT after. COGS. Gross profit. Insert a row below that says gross profit is equals to 650 minus that. 425. Then we have expenses, wage depreciation of 45. Insurance is 6. Right? Then do we have EBIT? Is that enough? Wages, rent. How I paid rent? I paid wages. I paid depreciation. I paid insurance. I paid for COGS. Yep. Done. Insurance expenses. We'll call this EBIT. And we'll call this interest expense. And we'll have tax expense. Right? That's how I do it. EBIT is what? 425 subtracting 150 subtracting 51 224. I'd insert a row below. I'd also insert a, yeah, that's fine. Expenses, gross profit. Maybe I insert a row below as well. EBIT. Then I have what? So we have what, 119K left? Earnings before tax or taxable income, right? And then it's EBIT. That's no PAT, net operating profit after tax. EBIT before interest and tax. Or profit before tax. Oh shit. And then I'd go taxable income, which is what tax rate is 25%. Sorry. I'd say 25%. Maybe I look into the answer sheet. Oh, sorry. That's what they did. They went sales, then they went COGS, then they went expenses, interest expense, wages is 80 plus 10, get depreciation 45, EBIT, interest expense is 5, insurance and interest. It works. Ours works. Slight difference. Yeah, ours works. Mark scheme is that. Yeah. Says in the balance sheet, what will be the closing balance of retained profits? Closing balance of retained profits for the year. So you start with the opening balance of the year, right? Opening balance retained profits would give me 440K. And then I'd have a list of these things. I'd have a profit before tax. Do they want that? Okay. Okay, whatever. They are calling this net income, but sure, I don't care. Works. Right? Right. Let's say net profit is 219,000. And then what needs to happen? Pay a dividend. What happens if I pay a dividend? Pay a dividend, what else? Yeah. Okay. Dividend. 50K out. And then we'd have our final, which is 609,000. Closing balance of retained profits 609,000. Nice. Nice. Okay. The important thing was this paper, so I think we'll do it again. We'll do the transaction again after. Okay, we're gonna do this a little bit after. We will do what we set out to do, which is the quizzes and the tutorial questions and additional questions. Let's start with the quiz. Honestly, maybe we can just make this into a page. And then we'll just run through the quiz, eh? It says the primary purpose of financial accounting is to provide information to internal or external decision makers. There's financial and management. So financial would be to external. Nice. Endorphins. Sorry. Endorphins. The primary purpose of management accounting is to provide information to internal decision makers. The primary skill developed through the finance units is to either value a business, improve business operations, measure the performance of a product of division, identify business profitability. It would be through the valuation of a business usually. Nice. Which of the following is not an external user of accounting information? The taxation office is external. Banks are external because they want to see if you're legible. Competition is definitely external. Employees aren't. Accrual accounting means you are recognizing the expenses at the time they occur rather than when the cash is received or paid. Yes, the first one. During 2023, a company makes credit sales of 600 grand, of which 300 is collected at year end. It pays 200 grand in expenses and owes 20K for electricity used in 2023. Okay, this is where we're going from baby questions to to not so baby questions. What do we call this? Okay. Credit sales of 600K. Sales 600K. Right, we're stripping away of whatever the amount is collected. Then it says it pays 222 in expenses. Right? And 2023 used during 2020 for electricity in 2023. So electricity, which is 20,000. So you have basically profit under accrual accounting is what, like 360K? Yes. company makes credit sales of 600 and 300, so once again not there. It pays that. What would be the expected, what would be the profit if cash accounting rather than accrual accounting were used? Okay, so this is a question, I don't know, A or some shit. B. I really like the blue color. So cash accounting. Credit sales of 600 grand. So 300 in cash collected. $350,000. It pays paid expense 220K. So you get 130K cash left. Very nicely done. Using the information given below to answer these questions, the cash sales is 20 grand, the credit sales is 60 grand, cash from accounts receivable is 42 grand. Net profit, okay, cash from accounts receivable. I'm assuming you don't look at the accounts receivable, nor you don't look at, or the wages paid, because you've already probably net profit for the month. Wages paid what? The month before or this month? I'm assuming it's this month. So cash sales, sure. Credit sales, sure. Cash from accounts receivable. Not cash from accounts receivable. Not cash from accounts receivable. That's not a revenue. Wages paid. Wage expense. Wages paid is an expense. Wage owed is 8. So wage expense. Wage expense. Both owed and paid is 18,000. Which is what? 80K minus 18, 62,000. Nice. During the 2022 financial year, a company makes credit sales of 600 grand, 475 collected at year end. It pays that in expenses and owes that. What's the accrual profit? So you just see credit sales, right? Yep. Uh, 2022 credit sales. $600,000. Oh, am I recording? This other AirPlay app is pretty nice. Cái này mượt vãi luôn. Đã. I like it. Sales 600. Pays 175 in expenses and owes expenses. Electricity expenses. Electric city X. $600, $225, $375. And it makes a credit sales of 600 grand. Man, if you make 600 grand, I'm chilling. What will be the profit? Cash accounting. It pays 175K in expenses. Sorry. So cash collected at year end. $475,000. It pays 175 in expenses. Paid expenses. Okay. That's it. Okay, week 1 is done. Let's call this week 2 from now. Okay. You know what's harder? Table integrals are hard. Right, I actually did. We're just going to copy this into second week. Sorry, guys. Which of the following statements about a balance? Wait. Let me see this one. How many MC? Oh yeah, there's barely any MCQs. Never mind. We're gonna close that up. Which of the following statements about a balance sheet is true? A balance sheet shows which sources of finance produced each asset. A balance sheet presents the financial information, position usually, which of the following is not shown in the heading of a balance sheet? The date as at, that's financial position for sure. The time period covered by the financial statement. The title, balance sheet, the name of the entity. I think it's the time period. Yeah, okay. That was tricky. Time period is usually not a thing that's related to balance sheet, because balance sheet is basically the snapshot photo or date as at of the company's financial position. Which of the following cannot be answered from a balance sheet? Should a dividend be declared? Can the company pay its bills on time? Is the company soundly financed? So leverage ratios, right? Or debt structure ratios. We can see that from the balance sheet. What has caused a changes in cash during the period? Yeah, that cannot be answered. Can the company pay its bills on time? That's how much debt it has. Should a dividend be declared? That's how much remaining cash it has. Yeah. Changes in cash can be resultant of many different types of transactions. A company could have collected cash, however, cash could also increase from cash sales. This information cannot be ascertained by looking at the balance period. Don't even, bro. Soundly financed means possibly leverage ratio, which could be seen from total assets and shareholder equity. Dividend declaring could come from high levels of ROE or whether or not the company has enough cash or retained profits, can bills on time would mean liquidity ratios. So looking at cash ratio, quick ratio, and current ratio of all of which can all be seen in the graph. What is not a revenue? Issue of shares is revenue. You could say rent from premises. Dividends received on shares. Dividends received on shares is dividends of other companies. Issue of shares means you raising capital. Sale of goods means you sell to get something. And rent from the premises. What does rent from premises mean? Rent from premises. So rent revenue is possible. Maybe this one? Yeah. It's a type of capital. It's not a revenue. Rent from premises means like real estate. And that could be a real estate company's revenue. I don't know. Sale of goods would mean selling of something. Issue of shares is more capital. Okay. Not recorded revenue in the profit and loss statement. I'm so hungry. I'm gonna spend money on my Fitness Pal or macro factor. Maybe I get a free shoe something from Mr. Will Tennyson from the Macro Factor app. My God, bro. 说情教係得偏有，冷嘅樓台碌嚟，講點錢問題，想亂嚟，入到舊線，聽嚟，講點錢問題，想亂嚟，又嚟講嘢講。 Xin người để người tôi yêu được sống. Xin người để người tôi yêu. Ừ, ừ. Được sống. Ừ, ừ. Câu chuyện của tôi còn kết thúc sớm hơn dự định. Nếu đây là điều cần thiết, nếu đây là điều đầu tiên trong cuộc đời này, tôi chưa may mắn hay van xin bất cứ ai điều gì. Nếu đây là điều cần thiết, nếu đây là điều đầu tiên, nhưng người hãy là người tôi yêu. Ừ, ừ. Được sống. Ừ, ừ. Xin người để người tôi yêu. Ừ, ừ. Được sống. Sớm hơn dự định. Do I even like YouTube? Câu chuyện của tôi còn kết thúc sớm hơn dự định. Nếu đây là điều cần thiết, nếu đây là điều đầu tiên trong cuộc đời này, tôi chưa hãy van xin bất cứ ai điều gì. Nếu đây là điều cần thiết, nếu đây là điều đầu tiên, người để người tôi yêu. Được sống.
Skip bus 1040.
What do you get?
1022 and 1000. Oh my god! Wait, I just ducked like 200. 3 credits? Yes. I have no luck. I got 36 credits. Don't even go to it. I want it. You should skip that color. My parents, the only reason my parents, the only reason, the only reason why I was eight, the only reason why, but the only reason why I transferred here was because they were gonna like.
No, please, no, I can't. In the class. I can't. I'm gonna die. I'm gonna die. I can't. I can't.
What's Neko? He's skating. You do know, like, if I don't do that class, it's like extra money.
It's not. It's an elective.
No way they.
I don't have to change the fucking bus 1020 class then.
Why?
Who the fuck is gonna work with your group? My way. Okay.
Wait, what? How long do I have this? I got 3 electives. What's Q bus then? Wait. This is different. That was Q bus for Ivan.
Bus hashtag. What's that?
Wait, what? They gave me Q bus? Got quantitative and also then you got still leadership.
I'm saying bus 1040. I don't think bus 1040. I think everyone should skip bus 1040. When solar. Alright. How am I going to take that to the top? bus 10:30. Yeah.
Yeah.
Something still bus 10:40. It's a little weird that I don't have like this.
What if it just lose my credit that transfer did what this guy class is supposed to do?
You guys should play it for my sister and me.
Huh?
And you guys should break the stats and you should learn stats properly anyway. Like this. You shouldn't think like, oh, like I'm like the past shit all the time. Why I was just the past stats. It should be like I need to understand what I'm learning stats. Field like econ, necessary in finance moves with market. What's the market and what's market?
Which of the following is an asset? Cash. Cash is the only asset listed. Retained profits is part of shareholders' equity. Sales revenue is a revenue, and cost of goods sold is shown as an expense. This will be discussed in week 2. To which balance sheet grouping does the item wages payable belong? Liabilities. Which of the following statements is not true? If the total assets owned by a company were 80K and shareholders' equity Some things we need to know about week 2 is total assets. Right? It's the seal, right? Yeah. Seal. Or SE is equal to right? So when they said that if total assets is 80K is equals to this one. Yeah. Or SE is about net assets. 80K is equal to 35K. Which is good. If total assets decrease by 50K during the period and shareholders' equity increased by 30K, liabilities increased by 80K for the period. So once again, we'll use the seal is equal to asset minus liabilities. And they said, okay, they said if total assets decrease, so asset minus 50K SE plus 30K minus liabilities. How to balance this? Liabilities decrease by 40 is wrong. Liabilities must increase. Pull the trigger. A company buys 100 TVs. Is he dumb or dumb? I also have like 4 to 5 more hours of daylight hours in me to maybe finish the second section. Oh, this section is good. Wait, I don't know if I need that many days. Maybe we could throw in like a Saturday or Friday night with math in the gym or some shit. A company buys 100 TVs. It sells 60 for 900. What's the cost of goods sold expense? Okay, bought 100 TVs. Inventory 50K at so inventory is what? 50 grand? Sold 60 TVs for 900. Cogs is 500 times 60, 30K. I might need another set of eyes on Comm11.
I hate to say it, but it's actually right. I see it's being torched in the comments. Say this.
Are they actually 2 chicken burritos? I want to track potassium, right? Oh, guess what? I also ate a shin ramen. Right? Yeah. What are we doing next? If the last wages bill for the year is paid on 28th June and 8,000 is owing in unpaid wages, 30th June is the end. The 8,000 would not be included in either the balance sheet. The 8,000 would appear as an expense. The 8,000 would appear as an accrued wages payable and it would appear as accrued wages when is the financial year in Australia? If I owe wages on 30th June, does it appear as an expense? It would appear as wages payable as well. Remember. Here, I drink my multivitamins. Given the following information, calculate net profit. So you don't talk about dividends. Do you talk about cost of sales? Yes, cost of goods sold. Wages. So 140. What? Looks like 110K left. Dividends received. 140K. Whew. That's fucking crazy. This means that dividends could be dividends received from other companies. So we need it as part of our sales. just like micro, yeah, accrual adjustments.
Norman. Of March, Harvey Norman sells 100,000 worth of TV. How does that transaction look? Transaction losses. Well, we use an account down here called accumulated depreciation to essentially accumulate count all depreciation charged on an asset. So, how does it look? Well, essentially, accumulated depreciation involves this schema the asset account. But it's a unique asset account because it's reducing the value of our assets. So every time we record cumulative depreciation, we need to reduce an asset by 2,500. So in this case, cumulative depreciation as an asset minus 2,500. Depreciation expense, we know, goes in our income statement. It's going to reduce equity. So we can have depreciation expense minus 2,500 as well. So in terms of our accounting equation, assets are reducing by 2,500 and equity is reducing by 2,500. So what does that mean for our balance sheet? So it means in our balance sheet in year one, we have accumulated depreciation at the end of year one of minus $2,500. So we call the book value of our machine at the end of year one will be the difference between the asset and accumulated depreciation. It's a challenging process to move through, but that's essentially how we treat depreciation.
You should borrow seal. Yeah, seal. Share capital plus opening retained profit plus revenue minus expenses minus dividends. Why is that shareholder equity doesn't account for tax? Or is it also just what you call expenses? you know that the revenue minus expenses part in the shareholders equity, is that expense also talking about tax expense and stuff like that as well? So in that big equation for the income statement, are they making it super general, and it's also like implying that we also have to pay tax as an expense? What's happening? Yo, is in the shareholders equities formula of share capital is yeah, of shareholder equity is share capital plus opening balance of retained profits plus revenue minus expenses minus dividends. Is the revenue minus expenses part, like, is that also accounting for tax as part of tax expenses as well? Or is it hello? Hello, hello, hello. Hi. Hi. I'm studying, Christine. Good question. Where can I put you? Here? Would be nice. You will be one. I think so. I hope so. Hmm. Yeah. Prepaid expense is usually some form of asset transfer from one of your assets to another asset. Accrued expense is you have more expenses payable and then you owe them money, so and your retained earnings decreases, but you don't spend money on it, so you don't spend your assets on it. Okay, I should remember accrued expense. Accrued revenue, you get something called a accounts receivable, and you recognize revenues. Right. Wages earned by employee is an accrued expense, where we've expensed it, but we haven't paid for it, so we're creating a liability. Where is that? Wages accrued. 10,000 in wages accrued. Unearned revenue is when we receive the cash, but we haven't delivered on it. So, cash increases, but deferred revenue is a liability. So, deferred revenue is the second thing. Unearned revenue, 25,000. Yep. Here. Use 15K of electricity, of which the company had not been invoiced. Used. So, and we haven't paid for it. Owed expense. An owed expense is a decrease in equity, right? And increase in liability. Yeah. So we increase electricity accrued as well as decrease electricity expense for retained profit. Purchase supplies costing 3K on credit and having $500 left. So you'd buy the supplies on credit, you get $3,000 worth of supplies, and then you get extra 3K worth of assets, and then credit is an accounts payable that you have to pay, and then at the end there's only $500 left, so you have to decrease $2,500 on assets, but also decrease $2,500 on supplies, which is retained profits as well. So what you'd have is accounts payable, $3,000. You used it, you still have $500 left, and you basically spent $2,500. 30K insurance covering June 1st to May the next year. So the final month of next year. 30K insurance policy on 1st of June. That's not good. 1st of June. But it's 1 year from now. And this is a table for opening balance of June 1st. So you're going to, 30K prepaid. That is a... That might be one of the... I can't remember words. Deferred revenue. Accrued expense. Prepaid expense. And revenue. Unpaid. Cash collected or accounts receivable. The prepaid expense is decrease cash, increase in asset for an expense like insurance. So 30K of insurance policy, that means we spent 30K cash, not cash, but debit, and then we opened a new account under insurance policy, and we used, well, 30K over 12 months is what? $2.5K a month. So we use 2.5K. So we just take out 2.5K, and that means this month we'll have 27,500 left. Yeah. Oh, and once again, we have to delete retained profits. Depreciation of equipment at 5% annual rate, straight line depreciation. So if we depreciate something, we also have to depreciate. We have to also reduce retained profit as an expense. Yeah. And 5% of we'll take 90K worth of equipment and give us our accumulated depreciation of this year that we'll just have to pay. Or at least we'll not have to pay, but we have to accrue. Okay. Okay. Deferred revenue is paid. No, paid by customer. Revenue recorded Rev not recorded. Plus cash minus plus liability. Accrued expense. Wages. Haven't paid. Expenses. Recorded. Liability. Account. Increase. Prepaid expense. Asset. Cash. And open asset account for prepaid. What's that last one? Accrued revenue. Think. Accrued revenue. Revenue recorded. Cash not yet received. Accounts. Asset account. Open. For account receivables. Deferred revenue is plus cash and plus liability. Expenses is expense recorded, liability account opened. Prepaid expenses asset, and accrued revenue is asset, revenue recorded, and asset account opened. Yeah, I think we're gonna look at the quiz number 3 now. Okay, let's play. If the owner contributed cash as additional capital, that would mean that the asset would have increased and then the shareholders' equity would have increased as share capital. This represents an increase in cash and an increase in equity. Given the following information, how much revenue would a company recognize in April 2016? If they received a deposit, how much revenue would they recognize? This might be one of the most interesting ones. You have to get used to it, and it just comes from repetitions. So deposit from client to be carried next month. So I don't think that's revenue at all. That's just this means an increase in cash and an increase in deferred revenue for next month. Was like right accounts. Second one, credit sales. Only 50 to be collected in April. So credit sales is 150K in April. $50K collected as cash. Credit sales is equals revenue, recognized revenue plus 150K. We recognize that we made 150K, right? Plus 50K in cash collected. $100K in accounts receivable. Cash collected account. Okay. Collected 20,000 from customers for March sales. Collected cash means no rev. Sold client goods. Sold client goods. Will invoice client in early May. Sold client's good. Okay, sold client's good means plus 30K in revenue and plus 30K in accounts receivable. Finally, signed contract to deliver client goods valued at 40K. So sign 40K contract. Right? To be delivered in May. Which means you still have rev, but plus 40K in accrued revenue. Right? Accrued revenue is oof. No. Signed contract to deliver goods valued at 40,000 in May. That's a deferred revenue then, I guess. Deferred revenue? If I signed a contract to deliver client goods next month, I record it in this month as revenue. So it's deferred revenue then. So where's my revenue? This is my revenue. This is my revenue. 180K. Cash increases, revenue does not increase. Only earned when services are carried out. Number 2, regardless of whether the complete amount of cash is collected, we have earned 150K. 3, no revenue is recognized. Goods will not be delivered to May, therefore revenue is earned in May. Goods will be earned in May. For the following transaction, identify the type of change that would have occurred in the accounting equation. The business made a loan to the sales manager. Assets is equal to liabilities plus shareholder equity. The business made a loan to the sales manager. That means the business made a loan. An asset decreased and a liability decreased. No. A liability increased and an expense increased. No, an asset increased and another asset decreased. Yes. Yes, there you go. Business made a loan to manager. Business made loan. So let someone borrow money. So cash account decreased. Accounts receivable increased. Identify the type of change that would have occurred when there was a payment made to the creditor. Well, the payment is made, so it's already recorded. So no expenses. A payment was made to a creditor. We would lose cash, and we'd also reduce a liability account. So an asset decreased and a liability decreased. A $10,000 receipt was received from an accounts receivable. Okay. As a result, we would increase our accounts receivable by 10,000 and increase our cash by 10,000. The 10,000 would have been recognized as an increase in accounts receivable. Now that the receipt has been received, we decrease the accounts receivable and increase cash. A company purchased goods on credit, and so on credit this means we have inventory now, and we also have a new liability, which is like accounts payable. A customer provides a deposit of $500,000 near the year end, but it won't be delivered until next year. This is a increase in assets and cash. Will this be an increase in total assets? No increase in total assets, only increase in cash, right? We get the cash, then we create another one that says, hey, deferred revenue, 500K in our liabilities, so our total assets and liabilities are normal. And net profit does not get increased, and we haven't earned it. Will it increase net profit, total assets, and cash? Will it increase net profit and cash, but not total assets? Increase total assets and cash, but not net profit. Increasing total assets does increase total. Okay, I guess it's kind of certain. I mean, sure, if we just want to think about it that way. Deferred revenue. Okay, this means implies plus total asset plus total liability. Right? This is minus equity plus liability. Right? Which is on the A is equal to L asset and cash. Prepaid expense, asset, cash down, and open cash account. So an account for advertising had appeared in an account for advertising that appeared in a local received paper was received at a newspaper was received. There was no previous record of the charge. An account there was no previous record of the charge. So it was an accrued expense. And for accrued expenses, we have to recognize that there's an increase in expense and an increase in liability. What is the effect of the below transaction on the accounting equation? Paid accounts payable. Paid. So I paid someone. I paid the accounts payable. I took cash out. So that was a decrease in assets, and I paid $60K in a liability account. Yeah, liabilities and assets decreased by 60,000. The supplies account has a balance $750 and it was debited during the year for $2,800, representing the total supplies purchased. If $950 of supplies are on hand at the next year, the supplies expense to be recorded is what? It was debited during the year. So they debited that. means, sorry, supplies account is a assets account, and it had $750, and then we'd debit $2,800. So we'd give that supplies account $2,800. You're gonna plus 2,800, and then a certain number so that we get 5,950. Well, that looks like, I don't know, 750 plus 2,800 gives me 3,500. That means this is $2,600 that we spent. Okay. Kiki, do you love me? Are you riding? So you never ever leave from beside me. Mm. Mm. Scary. What am I doing? Week 3. That's gonna be fine. It's not like I don't know this. Because if I didn't know it, I'd already take note of what was wrong, you know, and try to struggle with it, but guess not. Okay, we finished our quizzes for the day. We do have a paper due tomorrow, so I think I'm gonna look at it like almost right before we go to sleep or something. Because it's 2. We have not set up Inspira. we have some toot questions and additional questions, maybe? That might be important. So maybe if I could look at some additional tutorial questions, that would be pretty good. I've never done any of the additional homework. Okay, we should do this. Tutorial. What is this? I trust myself. Additional toot. Wait, why is it telling me? No, don't show me the solutions. Solutions? Is that not what came from here? 1.4? No, it's 1.5 and 1.6. Dame okay? Okay? Access to the ebook. So it's telling us to do the additional questions or no? That looks like we shouldn't do it then. I mean, we can look through it pretty quickly, but like one point what? 1.4, 1.5. We could do the question again, and we could do our tutorial homework again. Three weeks of tutorial homework, or do I just go straight into ratio analysis? I could just go straight into ratio analysis. I have a good enough view in my head of what we're supposed to do. Finish this. Each attempt contains the exact same questions. Okay. Okay, yeah. So, no homework bullshit. Practice, I don't know, Reddit, Comm1140, final. Anything else? Doubtful debt is added bad because it's not considered bad. How would you find EV with competitor EBITDA? You would. 11 point. If he gave you like share price, then you would be able to do it. Okay, whatever. Okay, I guess I don't need to do that. I think we'll just ram on. Thing is, we are unable to re-enter or re-access. So we should just do this one. Statement of financial analysis. 25 marks. Is this not the thing that the guy taught? 40, 330, 2760. Maybe this is something. Okay. I should do another. Okay. What I will do is just make sure we get this one right again. Okay. Yeah. Purchase inventory from supplier worth $250 cash. Purchase inventory. Subs 250. Get an extra 250. Recorded sales revenue. And 650K constituted into cash sales. 500K came into the cash sales. Okay, what we should do is like, what is this again? Property, plants, equipment, accounts, depreciation, payable wage level loan share capital. So this would be, sorry, we'd like paint it that or something. And you've got this inventory period, yeah. All of this is like share capital. Yeah. And paid profits is that. Obviously, we want to make sure that like we know exactly what's being asked of us. Right. Right. Recorded sales revenue, of which 500K cash constitutes the sales. So what we have here is revenue. So we should record revenue. Yeah, we should record revenue of 650K. And then we should record 500K in cash. And then we should also record 150K in accounts receivable. Then they said we collected 325,000 from accounts receivable. So we should get 325 more from accounts receivable, and then deduct 325 here. That stays balanced, right? Up bank, down bank. Yep. Cost of goods sold was 250K. So we sold the goods. So that's an expense. And we would, it's inventory that we sold, right? So it should be an expense. Yeah. Five is paid interest expense. Once again, it's an expense. 5K. And where is there this? Paid interest expense of 5,000. It looks like we paid it with cash. So we record the expense, and we also record the cash. We paid wages of 80 grand. So we paid 80K with the wages, and we paid 80K with the wages. Then the following transactions need to be recorded so we can measure the income statement. That means this is like accrual adjustments. Prepaid rent was for 2 months rent. So we're looking, okay, prepaid rent of 10K at July was for 2 months rent for July and August. And on August, which happened this year, the company paid another 60K worth of rent, right? So that means the company, sorry, that means we spent our first 10,000, right? 10,000 for rent was spent. And then I'm spending another 60,000 here, but then I open an account here. And then what happens is, we have until August 2023. Right now we're in June 2023. So we've got the whole of July 2023 and then the whole of August 2023. That means you still got 2 months left. That means we have only spent up to this date 50K. Oh. Alright. Prepaid rent. That was 10,000 in rent. That would also be a $10,000 expense that we have to record, even though we didn't lose any money. But that is an expense that we have to record. And then also, once again, a $50,000 expense that we do have to record. Then there's a depreciation that does not look like we paid at all. So it just says depreciation. So we're depreciating, and it's once again an expense. An insurance policy was taken out. An amount of 12 grand was paid for 12 months from 1st of January. So we prepaid rent, right? Sorry, we paid rent. So we spent 12 grand on rent, and we on insurance, and we got $12,000. We opened that. We shifted that to our prepaid asset. An amount of 12 grand was paid for 12 months from January to December. So it has been 6 months from then. We've used 6 months worth. So 6K. And once again, we also have to record 6K worth of expenses. On June 30th, the director declared and paid a dividend of 50 grand. So a dividend takes a hit on our retained profits and takes a hit on our bank money, right? So we have to, just the profits is just a number, but the bank is the thing that we have. So that's where, oh shit, we're paying that, and the bank is the bank debit is financing that. On June 30th, the directors declared and paid a dividend. Yep, 10,000 of wages relating to June 23rd, 2023 have not been paid and need to be accrued. Yeah, 10K in wages have not been paid. That is a $10,000 liability. You see how it's liability and it's not added? So a liability is something you have to pay, right? So it's still expense. 10K without expense. And paid accounts payable balance in full. That means we spent what? Paid accounts payable 60K, right? So we're just gonna deduct 60K from here, and to balance it off, we will take away another $60,000 from here. Okay, I understand now. Do we have this as our big boy guide? Okay, well, it does look like I fucked up somewhere. Or did I fuck up somewhere? No way, I didn't fuck up anywhere. 10K. Where? 10K of... Ooh. Let's just check the mark scheme. because I've done it so much different than my previous one. I don't even want to look at my previous one. Yeah, looks like we're, well, firstly, on this account, we have 4 here, 2 here, 3 here, and they all look good. Yeah, we're good, we're good, we're good, we're good. It's good, it's good. It's good, it's good, it's good. Okay, let's do the Taylor Swift one again. Same concept. Right. And this is a lot. Now I can actually understand everything. Comm was incorporated for 1st of July. The actions occurred during the 2022 financial year for Comm Ltd, whose year end is 30th June. Okay, so all these things happened within this year. They issued share capital for 4K cash. Issued share capital. Okay, so money came into the business at 4K, right? And let's actually keep this thing out. The S shareholder equity is A minus L, right? So if this increase, I'm gonna use this color. If this increase stays balanced. Right. We purchased 70K of inventory on credit. So inventory is now opening up a new account on inventory for 70,000, and on credit, this means that we have $70,000 for an account payable. So that's balanced. What we do here is we bring this to this side. It'd be SEL is equal to A. Or actually no, we just do this. Increasing this, increasing this. We sold inventory costing 60 grand. So that's our cost of goods sold for 190 grand, and all sales are on credit. So firstly, we would start with a revenue of 190,000, and then we deduct 60K from actual inventory costs. Ooh, is that why? Ah, okay, here. This is cost of goods sold. 60K, right? And then that cost of goods sold is balanced right there. That 190,000 is purely on credit. So we make 190, we create a new accounts receivable for 190 grand. We received 100K from accounts receivable. Transaction 4, right? So we're gonna cut this down, and then we received 100K. So that's an adjustment. We paid dividends of 40 grand. So dividends of 40 grand means we're deducting this and deducting this, which is decrease here, decrease here. We paid 32 grand to accounts payable. We paid 32 grand to accounts payable. So we had to lose 32 grand here and gain 32 and lose 32 grand here. Right? Which is a decrease in both of these guys. We paid wages of 90 grand and wages of 10 grand had been earned by employees but not paid at year end. Wages of 10,000 had been earned by employees but not paid. We paid 90K but still not paid. Had been earned by employees. This one looks weird. We also, I'm assuming this is ours. Oh. Give me another set. Yeah, okay, so it did give me that. Okay, let's continue. Paid wages of 90 grand. How do you pay wages of 90 grand and then had been earned by employees? So that's what? Wages of had been earned, but we have not paid. So it is an accrued expense, something we have to pay, right? Okay, so there's 10,000 more. Is that what you mean? Wages payable is 10 grand. Here, let's just pay wages first. Pay wages. $90K, right? That's an expense for $90K. Wages of 10,000 had been earned, but not paid at year end. So 10,000 more. Okay. Pay wages and accrued expense. Yeah, I think that's exactly how we did it. Yeah. Yeah. On 1st of June, we received a deposit that was to be carried out in the next year. So we had cash, right? And we'd also have deferred revenue. Yeah. So cash, right? Influx of cash, but influx of deferred, and open extra 70K in deferred revenue. Alright. 8. Cash is increased. Unearned revenue also increased. Used 15K of electricity during the year for which the company had not been invoiced. So that is a not accrued expense, but wait, it is an accrued expense. Yeah, it is an accrued expense. Hell yeah. 15K electricity expense and accounts payable is 15K. Purchase supplies costing 4 grand on credit. At the year end, 800 of these supplies remained. Purchase supplies costing 4 grand on credit. So what's our expenses of accounts payable also increased 4 grand. Supplies is 800. And expenses of 3,200. Does that fit? $800 minus 4,000 gives minus 3,200, and equities minus 3,200. Yeah. Okay. Right. Accounts plus 800. Supplies plus 800. Accounts payable is 4,000. Retained profits is minus 3,200. Okay. We paid 24 grand worth of insurance. We paid 24 grand in insurance covering October to 30th of September. So we still have 3 more months. We have 1 more month until July, 1 more month until August, 1 month until September. Okay, so 3 more months. And we paid that shit in October 1st. So prepaid insurance is, let's create another cell. We prepaid insurance, right? So we spent money on insurance. And we have insurance. And then we used up how much insurance? October at 2 grand a month, right? Yeah, at 2 grand a month for until we have 3 more months. So 9 months. We used 9 months worth. We have, that was like 18 grand gone. October, November, December, yeah, 18 grand. And that's an expense too. 18 grand worth of insurance. Wait, this is sick. Electricity payable. How do we do electricity payable? Nine. 15 grand electricity payable. Okay. I hope that's right. Do we have a tutorial material? Toot solutions. Let's see this. It's been a while. 384, 10, 90, 800, 6,000, 42 grand, 10,000, 10,000, 70,000, 15,000, 400,000, 42,000 alpha minus $46,200. Are you sure? Is this just not? Oh, yeah, it's me. No, it's not me, sorry. It's the tutor. Wait, good. I know how to do accrual adjustments now. My head is tapped in enough to understand. How did they do this last one? Okay, I guess that they could do that. But we basically did the same. What we... Yep. Okay. It's good. Moving on, I guess. Wait, I may go eat some kangaroo, bro. Wait. I'm eating kangaroo every day then. Better macros than chicken, cheaper than chicken. financial statement analysis, we will do it like it's timed. Right, that's the revision workshop paper. Do we want to do the revision paper by ourselves? Sure. And then we'll do the quiz. The more we can grind through these papers, the quicker I can get like comfortable and study for more shit. Right? If we can finish a lot of these things, then we're fine. Why is commerce so chill? This is something new. We'll see how this goes. You observe that return on equity has changed from 2023 to 2022. You want to analyze the reasons for the change to evaluate where you should invest in the stock. So we'll do ROE. Let's turn this off, actually. Oh, this looks nicer too. Let's keep it here. ROE is NPAT, right? Net profit after taxes over shareholder equity. Leverage ratio is total assets over shareholder equity. Profit margin is net profit over revenue, sales revenue. And asset turnover. We haven't seen the other ones, eh? Total asset turnover is asset turnover. Sales over assets, right? Sales revenue over assets. We'll look at the ratio list to make sure. Oh my god. Yep. Total assets, sorry. So what have we not looked at too much? Haven't looked too much on inventory turnover, debtors turnover, all the liquidity ratios, the price earnings ratio. We also haven't looked at. We've looked at that. Okay. What's total assets? Total assets for 2020. For 2020. No, let's do NPAT first, which is profit after tax for 2022. That's 40 on shareholder equity. 2936. And we want these as that. We want this as this. Total. What's this next one? $330 on 5160. Sorry, not 5160. 3560. We want total assets over, so leverage ratios, total assets. 2022 is 3936 divided by, what's that? Shareholder equity 2936. $2023 total assets is 5160 divided by 3560. Profit margin is 40 over 2760. Profit margin here is 330 over 1300. Right, and this is equals to this times this times this. Sorry, not that, not yet. Asset turnover is what? Sales revenue over total assets. Sales is 3100. Sorry, 2760 over total assets for that year is 3936. For the next year, we have total asset is, asset turnover is sales over total 5160. Okay. And then what we'll do is this is equal to that times that times that. And then we copy to this side. And then we want to turn both of this into percentage. This is the DuPont formula, which is L ratio times PM times asset turnover. Okay, that aligns. Let's keep everything clean. Okay. So we get 12 marks right there. Then we want to recognize that first thing we see is ROE increased greatly, almost by how many percentage points? 9.27 minus 1.36. by 7.91 percentage points. That's point number one. Profit. Let's not talk about profit margin yet. We want to talk about, well, asset turnover. So asset turnover did not help drive our OE growth because it decreased. Asset leverage ratio did increase slightly from 1.341 to 1.449, which is a slight, which can contribute to ROE growth. Profit margin is most important, is main key driver for growth, sitting at also 10.2 percentage point increase, which looks like the greatly affecting ROE growth. When analyzing why the previous year's profit margin was impacted, we should notice that interest expense was 400,000 more. We can see that interest expenses were almost 400,000 more at an EBIT of earnings before, at an operating income of slightly the same, 5.272 and 5.57. So as an investor analyzing how to keep interest expenses low, will continue to increase profit margins. Discuss what numbers indicate to you as a potential investor. Okay. The below information relates to Drake Limited, which manufactures and sells commercial The company is constantly profitable and has those statement ratios. Profit margins 15%, current ratio is 2.2, and debt to equity is 0.8. Debt to equity's total liabilities on shareholder equity. Okay. For each of the following transactions, indicate the directional effect on the profit margin, current ratio, and debt equity in the table below. A blank response will be marked as incorrect. Drake Limited borrowed an additional 200 grand as a short-term 6-month loan from the bank. Okay. A. Let's do this here. why commerce doesn't require any studying. What the hell? Could go in and just like kind of fuck around and maximum grades. But that means I have so much more time for e-commerce, which I would love to do. We recommend. See what happens this year. Ow. Drake 200K short term. Drake 200K short term loan. Six months. Bank. Each are 3 marks. Currently, profit margin, 15%. Current ratio, 2.2. Debt to equity ratio, 0.8. Okay, so let's do some analysis. A $200,000 short-term loan, not bad. A short-term loan, right, means okay. Okay. This means you get a new $200,000 in cash, which is a current liability, a current asset, right? And you get an extra 200K in accounts payable, right? Which is a current liability or loans payable. Okay. If PM, right, this is equals to net profit after taxes over sales. There's no correlation to net profit after taxes. No change. Current ratio, is equals to current assets, okay, over current liabilities, is it? Yep. Right. For current assets over current liabilities, and it's sitting right now at a 2.2. Right? This means that current asset is currently bigger. Current asset is bigger than current liabilities. So let's choose 2 to 1. Add 1. We get 3 on 2, which is 1.5. And this was 2. This is 2. So, because current ratio was larger than 1, increase in asset and increase in liability resulted in a decrease in current ratio. Right? Finally, we're going to look at debt to equity. Debt to equity. And it's sitting at 0.8, and it's equals to total liabilities over shareholder equity. So since current liability is a subset of total liabilities increase over SOSE, no change. We didn't record any new revenues. We just recorded a loan. So this means that there's an increase in debt to equity ratio. Okay. Situation 1 has been very, very nicely done. Let's look at situation 2. Sold obsolete inventory. Sold obsolete inventory. Purchased for how much money? 75 grand. So this is the value of inventory for 50K cash. Ooh, cool question. Alrighty, let's start. We're going to analyze first that we will have a 50K increase in revenue from sales, right? So this is the shareholder equity side of things. Right, 50K rev from sales. We'll also have a expense. So cost of goods sold is subtracting 75 grand right? What else? That's it. But on the balance sheet side of things, we have 50K cash, which is an increase in current asset cash account. And a decrease in $75,000 in inventory account, which is a decrease in current asset, right? So this results in a net 25K loss, which is seen here as well, which is a net 25K in asset reduction. Okay. For the profit margin, for this is not nice that the shit is like touching each other. For the profit margin, we have net profit after tax over sales, right? So what we do get is a decrease in net profit after tax and an increase in sales. So profit margin is at 15% because profit margin is 15% and it's larger than 0. Decrease in net profit with a larger base means decrease profit ability. Right. For what? Current ratio, which is currently 2.2 current assets current liabilities is equals to 2.2. We have a decrease in current assets, right? We have a decrease in current assets and a no change in current liabilities, which results in a decrease in the current ratio since CR larger than 1. Even if it's, yeah. For debt to equity, is there any change in debt to equity? Oh, yes, there is. There is total liabilities over shareholder equity. Well, we know that total liability stays the same, but share equity has decreased. Ooh. Means smaller base, right? 1, 3 to 1, 2 implies that we have a larger debt to equity ratio. So increase debt to equity ratio due to a change in profit. Very cool. Paid 100K in dividends. Paid 100K in dividends. That have been previously declared. So this means no change in in retained earnings. Right. Let's take a look. Just paid, right? Okay. 100K cash. Dividends. That's it. For profit margin, net profit after tax over sales, no change. No change. For current ratio, yep, that's going to change. Or is it? Oh, yeah. For current ratio, which is 2.2, so 22 over 10, basically. Minus 1 minus 1, 21 over 9. 2.3. So since in current ratio is going to increase. Liabilities gets a lot smaller when assets get small. So, yep. And for debt to equity, total liability over SE, it shows that we have a decrease in total liability and no change in SE for a 8 on 10, right? Now we're going to a 7 on 10. So we get a decrease in debt to equity ratio. We're chill, bruv. Let's look at the solutions. So they want to keep asset turnover that. Who gives a shit? The increase is primarily driven by the substantial improvement in profit margin, indicating enhanced profitability. The decrease in asset turnover and slight increase in leverage warrant further investigation into the company's overall financial health, risk profile, and okay, yapophobic. Okay, let's see if it happens. For our long-term bank, right? A is no change. Current ratio is decrease. Debt to equity ratio increase. For our B, profit margin decreases. Decrease in current ratio and increase in debt to equity ratio. For our profit margin, no change. Increase in current ratio and decrease in equity ratio. Okay, we're chills. We are chills, boys. We are going to now go into our tutorial material, and we're gonna try to do some maybe either the same JB high five ratio analysis, or we're gonna firstly do the quiz. We're gonna do this quiz.
As an economist would think about this, or as a finance put there on the next person doesn't help. Capital, too low values again indicate potential risk to financial solvency, just as we discuss. And now it's important here, maybe more so even than with the customer side, that between companies, payment terms are negotiated, and how good or bad they are for one side or the other depends on the relative negotiating power or bargaining power. Usually the bigger company wins is basically how this works. So let's say you're a company and your suppliers give you a certain payment window. They allow you certain payment terms. Quite often this would be something like 90 days. So they deliver inventory to you today, and then you got 90 days to pay them back. And so the turnover measure again is like how much stuff do you buy over the year, and how much is at any point the stock of that number. So here again, technically you're supposed to use supplier purchases, but to some extent you can approximate this by cost of goods sold, just similar to that. In this example, you purchased $400 of that throughout the year. At any point you're owing $100. In other words, it seems like you're turning over your accounts payable 4 times a year, or you take 91 days to pay back your average supplier. And DPO here is days payments outstanding or something from the previous slide. All right, so in this case, when you take 3 months, that's about standard measures. If it's the other way around, well, then you get paid early and you sit on that cash for a while until you have to pay your suppliers back. And so you're having some excess cash. Whitney is able, and then it's gone at the end of the year. Well, then you had to, well, this is a couple of short-term debt. Accounts payable, taxes payable, and again, some other stuff. And so the difference between the two we call the net working capital. And you can already see that if this is highly negative, well, then you may have problems, obviously, servicing your liabilities just from current assets. You will need some other things, and we'll talk about that in a second. So this is important because it tells you something about how effective or efficient management is in managing this part of the operation and generating cash flow from operations. If working capital is very low, in this case, for instance, negative or very negative, then what that might tell you is that the company may have trouble to paying its short-term financial obligations, and this may have some serious consequences.
Do I now go to class?
If it is too high, on the other
this day?
hand, then this might suggest that there's way too much cash and other short-term liquid assets lying around on the balance sheet that could be used better for other, productive purposes, right? And so this might be inefficient use of resources. Yeah? Okay. And so to measure this, we have a couple of ratios. The three different ones, and they sort of differ in the, I guess, stringency or the immediacy with which you want to be able to pay off some part of your liabilities. The current ratio is simply current assets over current liabilities. So assuming you can convert all current assets to cash within the year, you can pay off your current liabilities within the year. If you have more of the art, well, this is pretty low, like is Woolworth in trouble somehow? And the answer to that balance sheet, that's already a bit of an art. It could be the end point of that period. It could be the starting point of that period. It could be an average. So there's already some degrees of freedom here. But in any case, you divide one by the other, and what you end up with is a turnover measure that tells you times per year, basically. Yeah? So let's make this a little less abstract. Or let me just go back and explain real quick what I mean by flow and stock. Right? So the income statement contains things that accrue and accumulate over a period, right? Like your profits, your revenue.
Oh, we just finished this. I don't know if I should be scared or not. Okay, I gotta get through the revision as fast as possible. I usually don't fucking like watching shit, because you just listen to it, you know? It's okay. Yapophobic. Here, these are gonna be... This tutorial question was gonna be hard. We should do this tutorial question after we finish this quiz. Yeah. What do I do tomorrow? You would call this done, right? I'd be done with this. What is this? Week 4 quiz with notes. Business taxation. Qualitative responses for the structure of the tax system. Yeah. That's it. Spam the test a couple times and... I mean, at least try to finish my first test, like, here. Maybe I should have used one more extra day for math. Comm1140. Oh yeah. Okay, finish this, do Comm1140 paper. Yeah. Here we go. bathroom.
during like bombs and stuff that was happening, and he was like, "Hey, I'm here for the workshop," and I was like, "This looks awesome for us. I'm really happy. I'm really happy that we're in this situation." And so we had the team spend the day with the six, and then we took them out to dinner. I bring that up just because it was a great like example of like something that took me too long to learn. Was that like when you have something that gets messed up, you can't just like refund somebody because they're still net negative, right? Like he still flew from Israel. If I said, "Hey, my bad, here's the money back," he's still gonna like screw this guy. You can't just make it right. You have to make it more than right in order to actually make it right.
Yeah, how's it going? I have to say thank you for dinner last time. That conversation that we had literally changed my life and changed my business.
Can I tell the story of what happened?
For sure.
So,
All right, if you were in the e-commerce space, reveal a little by over 10,000 satisfied customers, and every single person sees this when they're getting into checkout. That rated 4.8 out of 5 by over 10,000 satisfied customers, and every single person sees this when they're getting into checkout. And most people don't even know that exists because it's just not something you can customize. Over here on the right, you have to do it in the theme code, and I'll show you how. So once you're in the default theme section, just go ahead and search alternative, and it's right down here. It says or, and usually that's grayed out or there's nothing there, and you can literally write whatever you want. This is your store right now. Most people don't realize is you can completely customize this tech right here. So I just have rated 4.8 out of 5 by over 10,000 satisfied customers, and every single person sees this when they're getting into checkout. And most people don't even know that exists because it's just not something you can cut.
Every decision you
All right, if you were in the e-commerce space, reveal a little tip. Hey, people.
Oh, sorry. I quit my job as a vice president at a very important bank. I work at a call center answering calls, and I'm ridiculously happy. Because 13 years ago, I jumped off the corporate ladder. I convinced my two business school friends to also quit their cushy VP job. The collective equity salary of $1.4 million to move back to the DR. But why the hell did I do that? As a kid, my dream job was to work in Wall Street. I left my island and my family, got coached by Morgan Stanley, and in my 20s, I was traveling the world as a VP. But as I was reaching my 30s, something was missing. I had no social life. I was constantly sick, multiple panic attacks. And in the middle of the jungle, in the African forest, I quit because no job should feel like that. It's a very abusive industry. Call centers, also known as modern day prisons, places where people can't even go to eat without permission. And I'm cramped up with humans. So I built a place that basically didn't treat you as a problem. We started fighting. We didn't have
The McDonald's in Vietnam just released a buzz fire hamburger, so I had to.
Right now, me and probably every single startup I know is really only hiring for one type of person, and that person is a combination of a decent designer, a decent front-end engineer, and someone who is willing to take a lot of product experiments. In reality, there are so few people like this, but if you actually want to be
Bitch, I'm about to blow up. What the fuck? Oh, fuck!
I'm really hungry. Caffeine, where's caffeine? If I could get some caffeine in me and some tangerines, and we'll go get some tangerines. I'm really hungry. Nói như con chó luôn. Usually if I'm hungry, I can't do anything. I have these creatine chewables. Sorry. 1, 2, 3, 4. Oh, just 3. Each one is 16 milligrams of caffeine. Very slight.
got 10% off, but maybe getting your order completely free just gets a lot more engagement. It's just a super clean, easy way to execute it. And then another great example of engagement is that not doing a basic bestseller email. It's a quiz on a best product to be with you. The thing that they do here that not everybody does, they have a click to reveal what your results are. So you're engaging with the customer while you're also getting clicks. Steal these and send this to your marketing team. 10 out of 10 marketing emails I've received recently. Steal these. We've got the goal system. It sets a process, first name, keyword, and word pickup. It's probably got sent to the whole list. And if you receive this, you're like, oh my goodness, I found a golden ticket. And it's not even revealed what the offer is. So now you're like intrigued. What is this offer? So you go to checkout, you find out you have use the code to reveal what that offer is. Brilliant. Next, we have your order can ship free. Another example of not doing a boring 10% off. Nobody cares about 10% off. The store's doing 70K a month, and I will show you exactly how it can go. They are running a really simple offer. They're giving 15% off the first order, and the trick here is to have the code actually on the product page and not apply automatically, so it feels more limited and valuable in combination with the bundle and valuable page and not apply automatically, so it feels more limited and valuable in combination with the bundle here. This becomes a very strong offer. They also highlight their three strongest benefits: a lot of social benefits, urgency levels, almost out of stock section, shipping timeline, show the customer exactly when they can expect their order. This also reduces a lot of mails from customers asking when and they just add some UGC videos showcasing the product. You can even do these with AI. I've recognized most of these sections because I use the same app. It's called Certified. So if you want to copy all of these sections, I recommend doing it with this app. You can download it from the Shopify App Store and use it as free. And honestly, in my opinion, it's really underrated because they have these product page templates, for example, which are fully fledged out product pages, which you can just plug into your shop and use and have them for a bunch of different niches, and you basically don't even have to build the page yourself. So I recommend testing it for free and trying it for yourself. The store is doing 70. Okay, but this
Oh, yeah, I feel locked in. Stimulants are good for me. When is racial analysis most useful? Racial analysis. So, why is racial analysis different? Comparing companies operating in different industries, comparing direct competitors. Comparing direct competitors for sure. Typical safe ratios for certain types of industries may differ from industry. Thus, using racial analysis to directly compare companies from different industries may not make sense. Comparing, okay, yeah. Comparing ratios of direct competitors. Which of the ratios listed helps to indicate the ability of the company to meet its current obligations? Debt to equity ratio. No, current obligations, current ratio. Yes. Which of the following ratios is not part of the DuPont calculation? Well, the DuPont calculation does not have inventory turnover. Return on asset is basically once again, ROE is what? ROE is ROA times leverage. And ROA is, you could split ROA up to profit times asset turnover times leverage. Which of the following could explain an increase in the gross margin ratio? An increase in the gross margin ratio. The fuck is an increase in the gross margin ratio? Oh, gross margin. I don't know why the fuck they'd use ratio for. It's kind of increase in gross margin. By the way, gross margin always, usually it's always less than 100%, right? Which is less than 1. So gross margin ratio would mean gross profit on sales revenue. So gross profit increase or a decrease in wait, gross margin is okay. So instead of talking about gross profit, how can gross profit be larger, right? COGS get decrease. A decrease in sales price of goods sold, a decrease in wages paid, a decrease in deliberation, and a decrease in price of raw materials. Well, decrease in raw material. Sales price of goods sold is bad. What I mean is like a decrease in that is legit the decrease in your price. So yeah, decrease in raw materials. I don't want to be a banker. I never want to be a banker. No more banking. Sales of Slider Limited are 250 million, and operating profit after tax. So net operating no PAT is 25. Asset turnover is 4 times PA. Fuck is PA? What's PA? Asset turnover is 4 times P per annum. Total assets. Asset turnover is 4 and it's equal to sales over total assets. Sales is 250 million. So do we need the operating profit after tax or now? Okay, well, asset. Sorry, where were we? Asset turnover. Asset turnover is equals to 4 is equals to sales over total asset, which means 4 is equals to what, 250 million? M1 total assets. So 4A is equal to 250. 4TA. So total assets is 50 what? 50 62.5 M's. A high debt to equity ratio does not indicate that the company interest rate increases come from debt to equity is different from leverage. Right? Leverage is assets over equity. Debt to equity current ratio. That does not mean anything. It's highly geared. Why is it highly geared? Is the leverage ratio or the debt to equity ratio the gearing ratio? Which one is it? Okay. All the limited's account receivable for year ended 30th of June 2019 was 150 grand. Okay. Okay. Cost of goods sold was 382,500 and gross margin is 15%. What is the accounts receivable turnover? Okay, I think I know where these questions will come from. Like these ratio related questions. So account receivable turnover, right? So receivable turnover is credit sales over cost of goods sold is that, gross margin is that, all sales minimum credit was accounts receivable is what? 1,500. Okay. And our answers are 2 point something times per annum. Okay. So we need to find credit sales somehow using gross profit margins. Okay. So I mean, okay, I know what to do, but like, okay, COGS 382,500, gross profit bang 15%. So since all sales are credit, let's find credit sales, which is, well, gross profit is equals to gross profit margin is equals to gross profit over sales, but gross profit specifically is gross profit is equals to sales revenue minus cost of goods sold divided by, right? Sales revenue is now equals to 0.15. X minus 382,500 is equals to this on X. Let's just multiply both sides by X. So we'll get X minus 38250 0.15X. Yep. Subtract, so you get 0.85 is equals to 382,500. Divide that by our number, and we get our sales to be what, 382,500 divided by 0.85. So we have 450K credit sales, right? Then it wants us to find accounts receivable owner. Therefore accounts receivable turnover is equals to, once again, credit sales over accounts receivable. Credit sales over accounts receivable. Okay. Which is 450K on 150K, which is 3 times per year. Hard Up Limited. Fuck is that name, brother? Okay. Right, let's just go next page. Or I'm so slanted, it's funny. Okay. Next set of things. Hard Up Limited has a current ratio of 0.75. So its current ratio is 0.75. Its current liabilities is 200 grand. And it borrows 75 from finance company, repayable in 5 years. Right. Borrows 75K. Right. If CR is equals to CA on, sorry, is equal to 3 on 4 of 200K on CA, then CA is 150K. Right. Then, if borrows 75K, this implies that, well, now we have CA plus 75K, CL plus 75K is 225K over 275K. Zero 0.818. 0.818. Nice. What? Oh. Wrong, Jaden. You're wrong. So this is good. What you do, you say this is good, this is good, this is good, and this is wrong. Because current liabilities is not the same as since it's 5 years, the CA gets in, but CL remains. So we have, therefore, this implies that CA plus 75 over CL is 225 over 200, which gives the new current ratio to be 1.125. I can't do this. The following question relates to PQR. What's PQR? Oh, just company PQR. Got scared for a sec. Company PQR. Like a fucking finance fucking paper, bro. ROA is 10 what percent? 10 cents percent. ROA is made up of what? Sales? Ooh. Net profit after tax over NPAT over total assets. And it's equal to what? 10%. Oh, 10%. Oh. Return on equity, 12%. So NPAT on SE is 12%. Um, and what current ratio is current assets over current liabilities 1.8. Okay. Additional credit sales is what? 2 milli. Cost price 1.5 million. Fuck is cost price? Cost price. Cost price. So is this COGS? Credit sales. Fuck is cost price? Oh, okay, sure. So net credit sales over short equity total asset. So yes, this means that we have a 2 million revenue recognized. We have a minus 1.5 million for COGS, which in total gives me a net for retained earnings, which implies a increase in shareholder equity. That's number one. Number two, we have 2 million in credit sales is equals to 2 million in current assets for accounts receivable, and what, minus 1.5 mil on inventory. Right. Then for ROA, what do we see? We see NPAT. NPAT should increase, and this means that plus 500k, 500k SE RE plus 500k current assets in it. Yes. So improve current assets. NPAT over total assets. Well, this means plus total assets. So total assets increase. But we have a 10 over 100 plus 1 plus 1. 11 over 101. That looks like we are going to be a increase in ROA. That's number one. NPROE, we have NPAT increase, and SE being what? 12. Okay. SE increase as well. Wait, NPAT and SE. NPAT and SE and NPAT and SE. I don't know. Right. Also an increase in ROE. And CR is what? Has there been any current liabilities? Not really. Okay. CA, CL, with this increasing, we get an increase. CR. All three of them increase. Which of the following would not explain an increase in current ratio? Presently 2:1 current ratio. So current ratio is CA over CL, which is equals to 2:1 right now. Okay, if we sale of inventory or sale of non-current large prepayment this one, big prepayment. Oh wait, no. Let's analyze. Prepayment means cash down, but current asset, but I don't know. Prepaid services open. So no change. Right? Sale of a non-current means increase cash and decrease building. So it would mean increase CA and CL remains the same, so increase CA. That's fine. Sale of inventory for profit. That means increase CA you get more cash and less inventory, but more cash than inventory value, right? So CA increases. So CR should increase as well. Prepayment means cash down and prepaid services open. No change. Nice. Okay. Tutorial material for this, and then try to do Comm1140. Biết ta đã mất nhau, muốn cùng anh đến nơi người xa tìm em như nhưng có tàn nỗi đau, muốn cùng anh đến nơi bình yên, tìm em đâu mấy khi Should we do it? See if we can recall these, and we'll do what? I don't know, a year or 2 years, maybe? ROE is net profit after tax. What's that? 2021, right? B17 over total assets. B34. Why is that? Why has that got a cross through it? Huh? I don't know, give me B18. Sorry, C17 divided by C34. Just gonna Do I want to do this? Yes. Jaden, if you don't do this, you fucking suck. What are some additional questions? làm đi, làm đại đi. Làm 10 phút là xong mà. Y17 trên fucking Y34. F17 trên F34 này. Return equity là what? B17 trên $57, ok. B57 C17 trên C57 D17 trên D57 E17 trên E57 and F17 trên F57. Net profit margin is net profit after tax over sales, so 17 over 6. B17 over B6. C17 over C6. D17 over D6. E17 over E6. And F17 over F6. Is that right? F17 over F6. Yes. Asset turnover is given by sales over assets. Sales over total assets, which is 34, and sales is 6. Okay, so B6 over B34. Yep. C6 over C34. D6 over D. Could I do D4 like that? Oh shit. D6 over D34. E6 over E34. F6 over F34. Something worrying. Oh, why is this not? Yes. Do it. This is getting kind of boring. Is this sales over inventory? COGS over inventory. COGS is your cost of goods sold based off of your inventory. So how many times is it for you to get shit out the way, right? So COGS, cost of sales, which is B7 over 24, so 7 over 24, okay? B7, B24. Is that right? B7 as a cog over B24. Yeah, okay. C7 over C24. Why is it negative? Oh, because cost of sales, okay. We want to make this not negative. How about like that? Now we'll be able to read it. It's okay. I won't do this one. Anything else for that? Bourgeois. Continuing on, ramming on, we will continue on with week 5 multiples valuation. That looks way more fun. Oh, solutions right there. Okay. This is going to be a good question to kind of end the night on. There we go, P. I think we'll end the night early, right as this question finishes. I'll wake up tomorrow so I can finish everything else. Alright, so we're done with this. And we're done with this. Now we're going on to this. So we can just do that, do this, and then attempt it by the end of tomorrow night. Attempt it. And then it'll give me a feel if I can do like maybe term 3 math and then like shit like that there so that I can kind of unsqueeze and unfuck my life right there. girls and with them. Let's see this question. Let's delete everything for now. Save. Save. Additional questions. Oh, this is so clean. Very high quality. Wow. Now I would totally buy it. These are clean. Mega clean. Alright, what reading? What is this? Week 1? Explaining the concepts of accrual accounting. It's not hard, so. Oh, that fixes it to the window aspect, which is way nicer. Rồi. Đây cơ mà. Boy. Let's delete all of this. We don't need any of this. It's all in our head, brother. Are the additional questions of any use? Yes. This is another question, right? Nice. So 2 possible exam questions. Week 5 multiple evaluation. Looks 504. Oh, it's the same fucking one. No! Okay. Averages across peer firm for all ratios in the table. Compute the minimum and maximum percentage deviations from the average. Okay. For all ratios, compute the averages across, just to be clear, every single ratio. Or, okay. Valuation ratios only. Oh, okay. They said find the average. Okay, no, this is gonna be a quick question. It's not even... Okay. We'll do the question here then. And then we could have our bad boy right here. Wait, if I just like put it right there, will my camera see it? Averages for market cap. Well, how do we want to do this? Well, there's a table, right? Averages. Averages. And then we'd have market cap of every single thing here. And then okay. Let's do it by 6350 plus 2423 plus 675 plus 326 plus 267. Divide all of that by 5. And we get an average of 2000.8. Minimum percentage deviations from the average. So like which company is deviated from the average? This is fine. 10163 plus 3472 plus 3061 plus 1192 plus 1724 323922.4 3922.4 7.36 plus 18.09 plus 9.76 plus 14.89 plus 6.55 divided by 5. 11.33. Price book 0.73. Sorry. Yeah. Where was I? $1.252. I hope to be the one that doesn't make any fucking mistakes because I work with numbers all day. If I get the numbers wrong, I hope it's not like a mechanical thing. If it's a conceptual thing, who gives a shit, right? Because that's my fault. But the other one is like really my fault. Okay. So done. Compute the maximum and minimum percentage deviations from the average. So we are going to highlight the maximum and the minimum, and usually we're going to calculate the percentage deviations. Alright, let's find the maximum number in the set. Subtract by the set average is my assumption. $504,765. Okay, maximum minimum percentage deviations. Multi max min max what market cap. Let's just take this out for a while. Actually, let's just turn it off. Go straight to the paper. Divide highest value from average over average. Thank you. Just made so I didn't waste my fucking time, so it's okay. Okay. Market EV, PE, PBook, PB. Let's just do PB. EV over sales and EV over EBITDA. EBITDA. Min max. We'll do fucking above average. Something like that. We have all these averages here that we'll just pull down. And then what we'll do, oh, this one doesn't have it. Google Sheets for now. 1 second. Let's better to use Google Sheets. So why the hell not? Right. Right. So then I take minimum, right? C10 minus C11. Could we do absolute? Yep. Over C11. Right, and then turn that into a percentage. I guess not. What would be this one? Absolute value open bracket of C6 minus average C11 over C11. 200% off. This is apps D6 over minus D11 over D11. Oh, all this is D9. Just charge my iPad real quick. E10 apps E10 minus E11 over E11 apps E8, is it? No, E7 minus E11 over E11. Should have ordered them because no, you couldn't. E what? F9 except F7 minus F11 over F11. Could it? Yeah, you should do G absolute value G7 minus G11 over G11 minimum. Oh, what did I do here? Wrong. F9. F7. F11. F11. 10, right? G10. H absolute value H6 H11 H11 H8 9 H11 H11. Okay. Please. Nice. Now I have that. Now another newspaper firm publishing another newspaper publishing firm has sales 600 million, EBITDA of that, cash of that, debt, and that many shares outstanding. Use the PE ratio to estimate the target firm's share price when the target firm's forward earnings are forward earnings. Okay. Share price is market cap. We're using PE ratio, which is, well, it seems to be like 11.3. Yeah. Okay. Here's when we pull back the fucking ePad. I'm gonna buy this. It's really good. I like it. I dig it. I dig it, brother. Huh? Okay. What does it say? What does it say I do? Everything I said I do, I would. PE ratio. So P E ratio is equals exactly 11.33. Sorry. Okay. We want to estimate share price. Company has forward earnings is what? Oh, what the hell? Lagging or what? What was that? Oh, okay. Forward earnings. 0.41 per share. Market price per share, earnings per share. Nope, not here. We would probably be using this price to earnings ratio. And they said use the PB multiple. So market capitalization over book value of equity. We have 180 million. We have $600 million of sales. We have some cash. They gave us PE. Sorry, PE is market cap over net profit. Nope. Market price per share, earnings per share. Here we go. Market price per share equals earnings per share. equal to market price per share divided by earnings per share, right? Which is given to us as $0.41. Wait, that's it. This means, wait, this is what? Implied? Implied. Then share price, right? So market price per share is equals share price is equals to 0.41 times 11.33. Okay. $4.6453, or approximately 6.5 per share. Okay. My bad. I have common case of OC. Dick! If the average enterprise value to sales for compared businesses is used, what's the best estimate for the firm's fair share price? And what would be the reasonable range for the target firm's share price? If the average enterprise sales for comparable businesses is used, what's the best estimate of the firm's fair share price? So we're still using averages, right? And that means average enterprise value to sales, which is this one, right? Average implied average EV to sales ratio is equals to what? 1.356, which is equals to share price, EV over sales, enterprise value over sales. Wait, that's it? Sales is given, EV is basically given. Okay, we're fine. Okay, if I have EV, what do I do with EV? If I had enterprise value and I was able to do that with my EV, then my EV divided by my EV would give me something, and I would find market cap based off of EV. Okay. Ooh, what a question, eh? So I was given EV, not really given EV, but that's EV ratio, and that's equals to EV over sales. What we do know is EV is the same as market value plus all of its debt minus cash, right? Which gives us a function for FE of that plus $18 million debt plus, sorry, minus $68 million in cash over sales of $600 million. Which now gives me MVE is equals to, sorry, or MVE plus 18 minus 68 is equals to 600 million times 1.356. 813 million. Okay. Plus 68. Minus 18. Gives us, so imply once again, of $863.3. Sorry, $1 million. Then to estimate share price, we have the nail in the coffin, which is market cap. Sorry. Net profit after tax of shares. Earnings per share. No, we're trying to find share price, right? And we found share price the other way using if I use the EV to sales, I'd get that. I'd get market cap. Oh, okay. We have to know that market cap is equals to share price times number of shares. So now we have 863 million share price times how many million shares? 180 million shares. So we get that divided by 180 in order to get, so implied in terms of EV sales is 4.797 or 4.80 per share. Okay, and this is the fair price. That's number one. And what's the range for the firm price? So range using percentage maximums. This one is average. So this is average. So what's the average? So max for a share price would be what? 18 more percent. And minimum would be, oh, I should not have done that. I cannot absolute value it. Fuck me. Okay, if I see absolute value, no, I can't even do that. I have to just do this. So there should be one that's over and one under. Okay. Better numbers to use now. Huh? So maximum price is 18 plus 15.78%. Or let's use green for plus, right? 15.78%. And down is min 18.88%. So we'll just do that. We'll just multiply $4.8 times 1.1578 is equals, or let's use this number. Let's use this number. 4.794 times 1.1578 times 1.1578 gives me 8. Bad. 4.79. Oh my god. I have to do that again. 863.6 divided by 180. Give me that. Times that by 1.1578. Which gives me a estimated 5.548, which is $5.55 per share. So that is the absolute max, and the minimum is, well, it's 1 minus 18.88, 0.188. Sorry, 1 minus 0.1888. And that number, so 0.8 something, times 4.794, 797, 4.797 gives me a minimum of 3.8919, which is 3.90 per share. So the fair value, or it could be anywhere from 3.90 to x to 5.50 per share. Okay. Next question. Which of the ratios would likely be most reliable in determining the stock price? So once again, stock price is share price the one with the smallest deviation, right? Which ratios in the table would be most reliable in determining the stock price of a comparable firm? We need a firm that is around the same size. I don't know this question. I mean, I'd still say EV to sales because there's the least deviation. For size, you see a market cap here of what? We estimated his market cap to be 800 million. So McAfee looks pretty nice. McAfee looks right in the middle. With market cap for EV, I don't know yet, but yeah. Okay, let's pull up these. So we were a little bit up and down. I think though we basically got the gist of it. See if I can turn this off. Okay, let's see. For minimum, maximum, 60, 111%. Did we get that? No, we didn't. Did we get the averages right? Oh yeah, okay. Why did you not do that? Here at 1.252, 111% for max. Let's keep this under and then fuck. Let's do this. Right. Okay. 19 to 22 or whatever for part B. So they, was I told to, no, I just use at least 2. The estimated share price is $4.65, which we were able to get, fortunately. And the only difference that we had between us and them would be, okay, let's see. They'd start with enterprise value is 1.36 times 600 mils. Enterprise value is that times, wait, so two ratios I want to remember. Market share, so our market cap is equal share price times number of shares. Second one is enterprise value is directly equals to 1.36 is what? EV on sales times sales. Oh my god, I did not need to go through all that. EV sales has the smallest min-max percentage range. Yep. So last question is most reliable would be EV sales ratio. Has smallest min to max percentage range. Okay. Nice. We did good. Clean. Not too hard at all. Not as hard as my math classes are. Khoa học tự nhiên is a fucking khùng luôn. Rồi đi thi khoa học tự nhiên vãi phải cứt. Cày toán mỗi ngày, học như một con chó để được HD. Ok, tắt ha. Save luôn. Xong rồi mình xong cái đó. Wait, that's it? Business taxation thì không khó đâu. Đấy. Mẹ vãi cứ tax rồi. Audit and internal control. 24 marks. Okay, so we should write up some nice written parts tomorrow. And then additional practice exam questions. No way. Okay. I get this sound.
Hi, in this video, we will learn how to complete handwritten responses when undertaking an Inspira on-campus invigilated exam.
This is pretty sick.
As in any online test, the test questions are in a digital format. You can view and answer most of them online. For example, if the test contains multiple choice questions with 4 possible answers, you can select A, B, C, or D. However, if you're required to provide a handwritten answer, you will need to go through an additional step in your online test. The exam question will clearly say if you need to handwrite your answers. Follow these steps to ensure you complete your handwritten answers on the answer paper correctly. Step 1. Locate the question code in your Inspira exam question. This code is unique to the question and to you. Step 2. Fill in the bubbles on your answer paper with your unique question code. It is recommended to use a dark pencil to fill in the bubbles completely. If you make a mistake, do not cross the bubbles because it will confuse the system when we scan these answer papers. Either start again with a new answer sheet or use a good eraser to remove your answer. Also, do not write on the back side of the answer paper. Use an additional paper if you need more space. Step 3. Complete the other
Oh,
details
it's like a
at the top of the
fucking.
answer paper.
Oh, okay.
The date of the test, the course code, and your ZID.
Fuck, we're actually fucking taking
Step 4.
a paper
Fill in the
test.
question number of the question you're answering. For example, question 1 or question 2, etc. Step 5. The page number of your answer sheets must be written as 1 for the first page. If you need an additional page for your answer, the page number will be 2 for the second page, and so on. Step 6. Provide your answer. Step 7. At the end of the test, you should double-check the question code and the field bubbles are all filled in correctly. Incorrect codes will not be recognized by the Inspira system. Step 8. When you have finished your answers, remember to go to the Inspira test and click the Submit button. This will indicate that you have finished your exam, and it will record the time that you finish.
What's actuarial
Step
2-1?
9. Before giving your answer sheets to the exam room invigilators, it is very important that you organize your answer sheets in question and page order. For example, question 8 before question 9, and page 1 before page 2. That is everything you need. To know about handwritten answers in an Inspira student resource site, or contact the
Sick. Scary. What the hell? Let's finish this quiz. Okay, nice. Fundamental analysis. Technical analysis is trading, right? Fundamental analysis is profit margins. What is technical analysis? Which of the following statements concerning the... Oh, what the hell? Ngồi dẻo hết cả người vãi cứt. Bảo sao cả người. Ôi rồi. Ôi rồi. Lúc mà nhìn nữa, nhìn như vậy thôi, nhìn thẳng thôi. Which are the following statements concerning the valuation of firms using the method of comparables is false? So CCA, right? Which is it? When is it false? Valuation was taking into account differences in the risk and future growth between firms being compared. That sounds really false. Comparables adjust for scale differences when valuing similar firms. Yes. if two different firms generate identical cash flows, then both firms should have the same value. Yeah. Two firms that sell very similar products will have different values if they are of different sizes. Yeah. Dumpster fire is the business of waste disposal. Okay. This looks like numbers we've already done. Wait, no, I guess not. Do we not go to class or something? No, it's just the last few weeks of class have just been awful. Okay, we've done this question. This one. On a particular date, FedEx has a stock price of okay, FedEx. Okay. Has a share price. $89.27. And EPS. Its competitor UPS had a EPS had a what was name it like that? EPS equals 0.38. Is that right? What would have been the expected price of stock if we assume they have the same value for the PE ratio? Okay. Okay. Then is it PE? Earnings per share over market cap. Stock price of that times number of shares. Don't have it. We only have stock price and earnings per share. Stock price and earnings per share gives you what? That one. Net profit after tax. Nope. If earnings per share is that, we get a price earnings ratio. Oh, that's what we call it. Ratio and multiple. Then price over earnings ratio is equals to right? $12.55. So this is how do you say that? I don't know. Then use PE ratio, right? here is equals to market price, sorry, share price, right, over earnings per share, which is equals to share price, which implies that share price is equals to $0.38 times 12.55 gets you 4.77111, which is approximately 4.77 per share. So this is equals to implied share price. 4.77. Which of the following multiples should not be used to value banks? Banks. Why banks? Sales, maybe? Because banks don't really have sales. They have, yeah. Okay. Which of the following would be in least interest in a bottom-up analysis? What is a bottom-up analysis? Bottom-up analysis. Never heard of that, by the way. So, bottom-up analysis. Start with small details about company. Then what's a current ratio? Board composition sounds like it's a good bottom-up analysis. Rate of growth of economy is way too big for a firm, right? Okay. Right, so you probably start with like, I don't know, employee data. Then you'd go to like management. Then you go to like board of directors. Then you go to like financials. Then you go to like competitors. Then you go to like market cap. Then you go to like regional. Then you go to like economy situation. Okay. Several valuation methods can be used to prove and estimate of a stock's value, since no single method can provide a definitive value. That is very true. Calculate the share price for a company called HP based on the comparable valuation method. You notice that Cisco Computer Systems has a share price of $118.59 and earnings per share of $5.8. Its competitor, Hewlett Packard, has earnings per share of $2.26. But why the fuck are they talking about share price? I don't even know anymore. I don't know, should I just like major like innovation and strategy? So target firm is HP. Target firm HP. You've got a comparable firm, Cisco, and it has a share price equals 118 bucks. Well, it's not getting any harder if you understand what I mean. It's just the same shit. And there's not enough practice. They give you one question to practice. Okay. Comparable. And then fucking Hewlett. Oh. Hewlett Packard has EPS 2.26 bucks. The estimated share price for HewPack shares is dollars amount. So this means you can use P on E ratio, right? I'm going to sleep after this. Approximately 20.4665551. 72. Oh yeah, I have to do my Comm1140. 1100. Then what is share price expected? Well, you have PE is equals to 20.44655 is equals to share price implied on, this is pure, 2.26. So you get this times 2.26 and you get a 4.46.2092. which is approximately 40. Round to the nearest cent. Yeah, it's the nearest cent. So 2 decimal places. 4621. Next one, we're calculating the share price again. Okay. US stock trading market, you notice that Visa has a share price of okay. And then GP has EPS. Oh my god. Wait, no way. We're gonna do the same thing, guys. 169.5, 12.2 times that with the 2.23. So we get expected share price for GP. $3.98. Okay, this is better. Last question. Last question's always more fun. Wait, satisfactory. Oh, that's so satisfying. Trulia is the business of real estate appraisal, $500 million in debt. So Trulia has debt. Book it's a lot of money. This is a lot. So many zeros, man. But they don't teach us how to make these zeros. They just teach us how to work for people that have these zeros. Come on, brother. Peers trade at 8 times scale, 8 times sales, 7 times EBITDA, and 4 times book. It's a lot of you'd be using these, right? So peers trade at 8.5 times the sales. So big question. I'm assuming PS. EV over EBITDA. I hear the sun is up. 7. 0.4 times book P to B. Earnings. Now they gave me 500K in rev, 550 million EBITDA, and guess the market cap based on earnings. Okay. Based on PE ratio is 19. Is equals to what? Market price? Market price per share, earnings per share? No. Earnings is not sales, so don't be too... Sales already. Earnings. Is market cap over net profit after tax. So is okay, is equal to net income is 275 M's, which implies that MVE implied from what, 19 times 275? And then using the multiples approach, market cap based on book equity value. PB. Yep. 0.4 MVE over book. Only thing I was slightly concerned about was the fucking. It's kind of crappy. I don't like it. Let's read it one more time before bed. If not, we have 5 hours to edit. You know what I mean? In mid 2022, a rise in wholesale electricity costs led the Australian Energy Regulator (AER) to increase its default market offer (DMO). This is from AER 2022, the regional price benchmark, a legally enforceable reference price that all electricity retailers must close to its customers in any price communications. Which is from the Competition Consumer Industry Code regulations. Energy Australia, one of Australia's 3 largest electricity retailers, faced a decision how to communicate these new price change communications to its 566,827 residential customers. You can either, option A, the transparent communication, present the price changes to the consumers in full compliance with the code, section 12, and the Australian Consumer Law, ACL, by including the lowest possible price and ensuring the average estimated annual price for a given customer type is legally accurate. Or option B, or the fuck, get me out of here. Or present the price rises using a misrepresented estimated annual price whilst omitting the lowest possible price to exploit customers' inelastic demand for electricity at the risk of contravening the code and the ACL. Fucking beautiful. For reference, Energy Australia chose option B, and the conduct drew a $14 million penalty by the ACCC 2024. Refer figure 3 for an example of misconduct to a consumer. A customer, you mean? Okay, we're getting close. Hello, thanks for being with us. We're letting you know about the upcoming rates. Different retailer. These are below the reference price. The estimated annual price is this, based on average residential customer. Option B would allow Energy Australia to preserve an information asymmetry preserve asymmetric information between itself and its customers. Because retail electricity is near homogeneous and supplied over a shared infrastructure, price or communication of price is the only dimension of competition for Energy Australia. While aggregate demand for electricity as a good is highly inelastic, demand facing an individual retailer is potentially elastic. Therefore, no. Because retail industry is near homogeneous and supplied over shared infrastructure, while aggregate demand is pretty. Because we'll say retail electricity is a near homogeneous good and supplied over shared infrastructure. While aggregate demand for electricity as a good is highly inelastic, demand facing an individual retailer like Energy Australia, is potentially elastic. Therefore, price or communication of price is the only dimension of competition for Energy Australia, for retailers. Since customers can switch freely, competition depends on customers being able to compare offers between companies. For retailers, is a significant by requiring accurate price information, by requiring retailers to present accurate price information to direct customers to the most competitive, by requiring retailers to present accurate price information and promoting allocative efficiency. Option B exploited the inelasticity of electricity demand. Its conduct overstated the estimated annual price, misrepresenting the enforceable figure, so the rise appeared as an unavoidable market-wide adjustment. This price anchor was able to exploit to their personal price increases. This price anchor was able to so customers were less sensitive to their personal bills. Furthermore, option B omitted the lowest possible price. That was the conditional rate a customer could reach by meeting the plan's discount conditions. A customer, unaware that a cheaper rate was available, would have simply paid standard price, and the difference between what they paid and what they could have paid accrued to Energy Australia as margin. Option B, therefore, not only exploited inelasticity and suppressed switching, but converted unrealized customer surplus directly into producer surplus. Asymmetric information. While retail electricity is a near homogeneous good and supplied over retail electricity while aggregate demand for electricity as a good is highly inelastic, demand facing an individual like Australia is potentially elastic because retail electricity is near homogeneous and supplied over a shared infrastructure. Therefore, price or communication of price is the only dimension of competition for retailers. Since customers can switch freely, competition depends on customers being able to compare offers, which is why the electricity code exists. To require retailers to present accurate price information, to require retailers to present accurate price information and promoting allocated efficiency. Option B was economically beneficial to the firm. Was economically beneficial to the firm. Its conduct overstated the estimated annual price, misrepresenting the figure, so the rise appeared as an unavoidable market-wise adjustment. This price anchor was able to exploit the elasticity of electricity demand as a aggregate electricity demand. So customers were less sensitive to their to price changes, thinking that this was so customers would be less sensitive to Wait, what type of good would you call aggregate electricity demand? Or aggregate electricity in an economic fashion? You know how like retail electricity is near homogeneous, but how would you call aggregate electricity? Is a necessity good.